now. But look at the longer end of the Treasury curve. The concern has turned from inflation to growth, and now we're seeing yields lower. The 10-year at 4.38. The countdown to the opening trade starts right now.
Good morning, everybody. It is 7 o'clock, 7:01 in fact, here in London. So just an hour away from the start of the trading day. Let's think about the Iran story and how it has escalated, Lizzie, over the weekend. Another morning where we find ourselves taking stock of the ways that we've seen escalation taking place. And that seems to be where the market's head is at, where the market is focused. So we've seen the Houthis entering the conflict, which is a sign of escalation. We've seen further US troops arriving and an expectation of more to come in the region. A Saudi airbase was hit on Friday, 15 wounded in that event. And we've seen President Trump musing on the possibility of taking Xauusd Island, of taking Iranian oil. He's saying in an interview with the FT, has been held back by others in the US who said that would be a terrible idea and a bad thing to do. But these are ways that the market is watching this conflict escalate. And it is that the market is focused on this morning.
Yeah, you mentioned the Houthi rebels entering the conflict. That's important because so far Saudi Arabia has managed to reroute some of its oil around the Strait of Hormuz, but the Houthis could complicate that. The Red Sea port of Yanbu is within their missile range, so we watch that from an oil perspective. You mentioned the possibility that Trump could take the oil in Iran via Xauusd Island, that in the FT interview. You also have little sign that Iran and the US are going to meet for peace talks soon. There was hope that it could happen in Pakistan. Pakistan says it's willing to facilitate this, but so far what we've only seen are the foreign ministers of Pakistan, Saudi, Turkey and Egypt meeting there to discuss how to end the war. And in the meantime, Gulf countries increasingly frustrated with the US, the apparent lack of strategy from the White House.
Right, and it is worth throwing into the mix then, as we've talked about ways that this is escalating, the ways that President Trump is talking about this and the progress that he is claiming. He's talking about talks, and he says that Iran has given us most of the 15 demands. Now, our reporting suggests that Iran has pushed back on those 15 and has instead offered 5 of its own in terms of conditions, including Iranian sovereignty over the Strait of Hormuz, which no doubt would be controversial to many. So we are watching the complicated and unclear nature of whatever talks are happening. Yes, messages are being passed via intermediaries between the two, but any more than that is very difficult to pinpoint. And as you say, Pakistan has offered to host the two nations. We will wait and see whether we get any progress there, because President Trump does say an agreement could be coming soon.
Yes, but in the meantime, because of this escalation or perceived escalation on both sides, oil higher this morning, still just shy of $116 a barrel. In fact, we're up 2.2% at just over $115 a barrel now, on concerns, though, of a wider, longer war in the Middle East. Brent up around 60% so far this month, and it's having a real-world impact. South Korea considering the first driving curbs in 35 years for civil servants. Australia looking to temporarily halve its fuel tax to shield consumers. And we've got a great long read on how the fuel crunches are soon going to start heading west as well.
Yeah, absolutely. And that was one of the messages coming out of CERAWeek last week, wasn't it? And plenty of energy executives saying, look, this is already a very present experience in Asia, and it will become more so in Europe over days and weeks to come if this persists. There was talk of this being like the 1970s for Europe, surging prices of oil cargoes, diesel shortages. So we'll watch to see if we get that. We know that certain leaders, finance ministers, central bankers certainly focused on this, and some of them meeting today remotely to talk about this. Aluminium is an area of focus for us overnight as well, because there we've seen over the weekend we saw certain facilities that produce aluminium being hit in the Middle East, and that region is responsible for 9% of the global supply of aluminium, and it is also a crucial metal that goes into manufacturing, the second most used after steel in the manufacturing process.
Yeah, used in cars, planes, solar panels. So if you get a sustained price rise for aluminium, then it would put even more pressure on manufacturers and inflation as well. Talking, though, of the wider market reaction this morning, I mentioned that, in fact, the concern has pivoted now from inflation to growth.
Yeah, absolutely. So bond markets giving us the first taste of what we've been discussing for a couple of weeks, Lizzie, the fact that bond markets had initially focused on inflation and so yields had gone higher. But could we see a time when bond markets decide that actually this is going to be persistent enough that we're going to have to start to worry about a growth impact? And that does seem to be what we're getting today. So has the narrative changed around the bond markets? When we look at treasuries, we look at the Australian market, the Japanese market, JGBs, we are seeing yields coming down, certainly at the 10-year and certainly at the shorter end on the Japanese curve, but across the curve on treasuries and on Aussies. Now, we're not unwinding the big spike that we've seen in yields over recent weeks through the month of March, but it does reflect something of a tipping point, perhaps, and we'll watch to see whether this is continued. So are there risks for the global economy, for the US economy? We're seeing certain bond houses now pretty comfortable with betting on yields coming down. So this is PIMCO, JP Morgan, Columbia Threadneedle. They're all saying that the markets are going to increasingly have to prepare for a growth hit, not just the inflation impacts that we've seen the markets focus on up to now.
And Goldman seeing the chance of an economic downturn over the next 12 months at 30%. PIMCO a more than 1/3 chance, according to them. That's the bond market impact. In terms of stocks, as I say, we have futures lower here in Europe, following the losses that we already saw in the Asia session, particularly in Korea and Japan. The MSCI Pacific Index at its lowest level this year on those concerns that you cite about economic growth. But futures stateside actually turning positive now. We've had that two-day slide on the Nasdaq into a 10% correction, and the two-day drop on the S&P 500, the biggest in a year to end last week.
Yeah, and it does seem that Europe has some catching up to do with the negativity during Friday's session on Wall Street, so we'll watch for that at the start of trade. That is still around 53 minutes away. Let us tell you about some of the stories that are coming, or some of the conversations, we're going to be having today. We'll be talking about emerging markets and the debt story there, because we are seeing the global narrative around emerging markets really interesting with the stronger dollar in mind. We'll talk to Elena Theodorakopoulou, Manulife Emerging Market Debt Portfolio Manager. We'll also speak to Richard Saldana from Aviva, Global Equity Portfolio Manager. So where are we in the equities narrative, and how does a changing bond market story get picked up by equity markets? What's the inflation, the pricing power look like for global stocks? All of that in focus. And Lindsay Newman will be with us, King's College London, visiting research fellow, to talk about the latest on Iran.
Let's also take a look at what else we're watching throughout the week. Today we have German CPI data, before tomorrow Euro area and French CPI data, as the French President Emmanuel Macron visits Japan and South Korea on Wednesday. On Wednesday we have the Artemis 2 launch and US retail sales data as well. On Thursday it's US jobless claims, and then on Friday it's Good Friday, so major financial markets will be closed in Europe and the US, but we do get that US unemployment data. To be precise, on Good Friday, Treasury futures and equity futures close a little bit early, so there will be some market reaction when it comes to that jobs data.
It will certainly be falling into a quiet market, though, won't it? But I mean, the data, would it have got much attention anyway? Will the CPI data get much attention this week? I wonder whether the CPI actually in Europe and other parts, some parts of Asia, maybe that will actually get quite a bit of attention, because the inflation story being as prominent as it is right now. This will be our first look at Eurozone inflation for the month of March, and we are expecting to see the impact of the war starting to come through. So an uptick from 1.9% past month, which of course is nicely below target for the ECB, and that's the narrative we've been telling coming into this year. We are expecting that to go up to 2.6% for the month of March, and so that is going to be something that the markets will be focused in on.
And it will be interesting to see whether the ECB's forecasts will prove accurate when we get this read on the actual data.
Let's tell you some of the other stories that we're covering for you this morning. French authorities have detained 2 new suspects over an attempted bombing near a Bank of America office in Paris. The French Interior Minister says the device was planted by juveniles, or young men, who were paid to carry out the plan. Officials have said the plot is likely linked to the conflict in the Middle East. France has stepped up security around Jewish and US-affiliated sites since the Iran war began. The UK Chancellor Rachel Reeves will urge G7 partners to boost domestic energy supplies and warn the recent surge in oil and gas prices is playing into Vladimir Putin's hands. Reeves will speak with finance and energy ministers and central bankers in an online call later today. We're told she'll call for allies to ramp up investment in renewable energy and nuclear power to wean themselves off gas. And NASA is still targeting Wednesday for the launch of its mission to fly astronauts around the moon. The 4 astronauts of the historic Artemis 2 mission have arrived in Florida. They are slated to climb inside the Orion crew capsule on April 1st, perched on top of NASA's massive Space Launch System rocket. From there, they will start a 10-day journey that will send them around the moon and deeper into space than any humans have gone before.
We have the opportunity to answer the question that could be the question of our lifetime, which is, are we alone? When we go out and meet people, people ask that all the time. Have you seen evidence of this? What can we learn? And the fact is that answering that question starts at the moon. The moon is a witness plate to our entire solar system's formation. It's a stepping stone to Mars, where we might have the most likelihood of finding evidence of past life. But it's also a Rosetta Stone for how other solar systems form.
Well, coming up here on Earth, Red Sea risks are back in focus as Yemen's Houthis enter the Iran war. We'll take a closer look at implications for the shipping industry and global supply chains. Plus, HSBC CEO George Eldahari says he's been ruthless in his approach to simplifying the lender. We'll get you some of our interview later on in the show. But up next, we'll be joined by Thanos Papasavvas, founder and CIO of ABP Invest. So if you've got any questions of your own for our guests, please do send them to us on IB+BBTV Go. Good morning from London. This is Bloomberg.
We're not saying Capfin's customer service is on point, but we're not saying that either. You didn't hear it from us. Here's a bit of what Mpumi wrote.
Capfin has helped me for years. They are reliable in times when you need them the most. Their service is so professional.
Apply online and see why more than 8,000 customers gave us a 4.7 Google rating. Capfin is a registered credit provider. T's and C's apply. Plan smart. Think Capfin.
Sir, could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon.
They had offered a 15-point plan to Iran. Did they ever come back?
Yeah, they came back on the 15-point plan. They gave us most of the points.
President Trump telling reporters on Air Force One that he believes an agreement could come soon, but the nature of any direct negotiations remains pretty unclear, beyond messages being exchanged via third parties. Earlier on Sunday, Trump talked of seizing Iran's oil resources, a move that would mark a major escalation in the conflict. Let's bring in Bloomberg Horizons anchor Jumana Basechi, who's with us from Dubai. Jumana, good morning to you. Another Monday working out where we are in the risk escalation around this. Despite apparent talks then to end the war, everything on the ground is pointing toward escalation. So tell us more.
That's exactly it, Anand. You just heard some sound there from President Trump suggesting that they could make a deal in the next few days, but certainly there's no indication that these negotiations are actually underway, at least direct or indirect negotiations between U.S. and Iran. Everything on the ground is pointing to further escalation. Now, of note, Friday evening, we had the first unit of these marine expeditionary units arriving to the Middle East. That's around 3,500 troops, 2,200 Marines. Lots of questions about how they're going to be deployed, whether there will be some form of an attempt to take over Karg Island, which is what he referenced in that interview with the FT. You just spoke about that. Wall Street Journal saying that maybe they could attempt a targeted raid to extract the enriched uranium stockpile that is on Iranian territory. At this point, we don't really know, but the fact that it has arrived to the region suggests the real possibility of further military escalation. At the same time, we talk about an intensification of military operations. On Friday evening, Israel struck a couple of steel facilities in Iran. They also hit a couple of nuclear research sites. On Sunday, also shrapnel hit parts of an electricity grid in Tehran, which caused temporary blackouts. And in retaliation to that, once again, Iran has lashed out at Gulf Arab states, hitting key infrastructure. They've hit the Prince Sultan Air Base in Saudi Arabia, causing a significant number of injuries. More than 15 U.S. servicemen reportedly injured, alongside critical damage to U.S. jets. And then they've also hit those aluminium smelters, key ones in the region as well, which is why you're seeing this big uptick in aluminium prices. And then just to add to that, another front has also opened up. Saturday, The Houthis have entered into the arena. They have started attacking Israel directly, a couple of attempts on Saturday morning, and they say that they're not going to let up unless those joint U.S.-Israel military operations, not just against Iran, but against Iranian proxies around the region, stop. So we have a confluence of factors taking place now, all suggesting that we're going to see amplification and once more intensification of military operations in coming days.
Germana, we appreciate the update. That's Bloomberg's Germana Basechi in Dubai. Well, let's turn now to broader markets and government bonds rising around the world as that Middle East conflict raises concerns that it'll derail global economic growth and revive demand for government debt. US Treasuries have advanced, with Australian and Japanese bonds in the Asian trade also higher, on speculation that surging oil prices may just be a harbinger of a protracted global fuel shortage. Joining us now for more is Thanos Papasavvas, founder and CIO of ABP Invest. Good to see you, Thanos.
Morning, Lizzie.
So you see the possibility, if I'm right, of a mild US recession at only 20%. Just walk us through that, because you've got the likes of JP Morgan and PIMCO saying that the bond market's underestimating the chance of a slowdown. Where would you need to see oil getting to and staying to see that recession?
I think there are some key reasons why we see that probability relatively low at 20%. Although we do see a slowdown, a probability of 30%. So 30% slowdown, 20% recession, 0% hard recession, and 50% continuing recovery expansion. And the reason for that is a number of factors. Number one is that the US economy has been very resilient. It has surprised broader analysts and investors in terms of the resilience, even during the US shutdown last year. That's number one. Number two, we also believe that we're heading or approaching the beginning of the end of this escalation within the Iran war. And the debate internally is whether it's between 4 weeks and 12 weeks. But we certainly see that ending by Q2, end of Q2 of this year, predominantly because of the midterms coming up, the issue of affordability, the price of oil. And for that reason, we do maintain a positive outlook in terms of the fixed income market. We've been positive on the Treasuries, and only last week we turned positive in the UK 2 years.
It's interesting because that sort of game theory logic has been the popular idea in markets so far. But as Germana was just saying, you've got the Houthi rebels entering the conflict now, thousands of US troops on the ground. Are we not at a turning point where markets start to think that this could be a...
Weekend Nkulu is here. Stand a chance to win 15,000 Rand. Enter online and rent a smartphone with PhoneYam and make your long weekend happen. 10 weekly winners. Apply online at phoneyam.co.za. Everything good becomes AM with PhoneYam.
PhoneYam. Longer, wider war.
Well, we've had 4 Middle East events, crises over the last few years. The first one, October 23, October 24, June 25 last year, and the latest one. The first 3 were quite sanguine. In fact, during June 25 last year, during the 12-day war, we turned positive. Korean equities, Turkish equities, Central Eastern Europe. This time, we felt it was different because the regime, the Iranian regime, felt threatened directly. The reason why we believe we're approaching gradually towards the end of that is simply because of the pressure points which we think that President Trump will be feeling with the price of oil if it escalates further from, we saw have 118 WTI crude, or potentially body bags if we go down that route.
So if we would see more fatalities on the US side, you mean Thanos by that? Interesting then, as he says, we speak to lots of people who, just like you, are thinking this won't go on so long because of the midterms, because of that real politics taking place in the US. But before this war even started, we heard voices saying this war won't start because of the midterms, because he won't want to risk higher oil prices into the midterms. I mean, what is the... Are you becoming more convinced of that view or less convinced? How is your thinking progressing?
The thinking has not changed so much recently. It's just a matter of the pressure point of oil. So if the price of oil does not escalate higher, then this can continue. The point is, what impact will the price of oil have on inflation, on the sort of the direct K economy, which we believe is going to be directly impactful and harmful.
Let me ask you about bond markets then, because you mentioned a couple of ways that you've been changing your view, recently upgrading, for example, the UK 2-year. And there has been this talk for a couple of weeks now. Are we underestimating the growth risk? You don't see a recession in the States, but maybe you see more of a slowdown than you did, and is that enough of a reason for markets to start questioning the sell-off we've seen in bonds more globally?
I agree so. I think so too. I believe that. And it's not just in terms of the impact of the economy. It's also that in terms of a broader safe haven. If we see a significant risk-off event, taking the S&P and risk assets down significantly, where is that capital going to go? Whereas post the GFC, we had the zero interest rate environment, we had private equity, private credits, alternatives. Now, some of those asset classes do have a slightly negative feel to them. So we believe that treasuries will be the sort of the balancing, the diversifier in a risk-off environment.
Okay. And just today, you know, we've got stocks selling off in Asia, set to sell off in Europe. They're only a touch higher here, over in the US. What would President Trump need to say to stop the S&P going into a correction? If he were to come out and say this ground offensive is going to be limited and short, would that be encouraging because it kind of confirms that there'd be a ground offensive, or would that help the market?
I think that's right in what you're saying. I believe that, in my view, it needs to be a little bit more than just a soundbite in terms of impacting the market, because as you're alluding to, as you're saying, we are moving to a second stage of this. So it needs to be a little bit more than just a soundbite to an interview, something slightly more constructive. And, for example, saying that of the 15 points, they do agree on some of them. Which are the points? How do we see that communication and that negotiation actually taking place from both sides? I think that would potentially drive the shift.
Thanos, how should we think about the data points that we're going to hear more on this week? We're going to get inflation out of the Eurozone. That should actually reflect some of the impact of Iran, just the very early impact, but it is a number for the month of March. So we'll be looking for Eurozone inflation. We'll also get US jobs data, and I'm not sure what impact that kind of data set will have in a market like this.
Yeah, I don't think the jobs data will necessarily be reflective of the current situation, and both continuation claims, initial claims have always been constructive. The unemployment rate has not really raised any red flags. I think it will be more about inflation. It'll be more about inflation in Europe. We've already heard from ECB's Lagarde saying that we're unlike COVID, which they totally missed. They're not going to allow this to be a policy mistake again, so they'll be on the front foot. Now, the big debate is going to be in terms of Powell Marsh, Warsh, will Warsh be more hawkish if the inflationary data coming through the US are slightly higher than expected? And that's going to be the big debate over the next couple of months.
Well, yeah, do you think that the reaction function changes with Kevin Warsh at the top?
I do, but I believe that he's an inflation hawk. People believe he's a dove generally. He's a dove because he believes that there are some transformational issues within AI which will bring the broader prices down. And if he's right, then it's worth cutting interest rates. But if inflation is high, I think it's going to be a hawk.
Okay. So President Trump shouldn't assume that he gets lower rates.
That's exactly right.
And some of that might come down to the AI story that you think is actually, well, that might be part of the reason why the US economy remains resilient.
Correct.
Yeah.
And also why we're also going to be looking at the employment levels within the information sector, which could adversely impact the upper leg of the K economy.
Just finally, quickly, gold. We're nearing bear market territory. Is it a buying opportunity?
We have not turned positive gold yet, and I think there's two reasons for that. We believe that there's just an element of profit taking, so asset classes which have done very well have really seen a profit taken to them. One of our clients basically said, yeah, that's a lazy solution, that's a lazy reason. The real reason, which I think is right, is that gold tends to be a slightly longer duration asset, and right now we're focusing on short duration assets.
I was also reading some talking about where maybe central bankers, emerging market central bankers, maybe have to sell gold depending on what's happening to their currencies.
Turkey. We did that.
Right, okay, so that's certainly worth something we'll watch, and we'll talk more about emerging markets shortly on the programme. Thanos, thank you very much. Thanos Papasavas, founder and CIO of ABP Invest. Coming up on the programme, it's worth now over for emerging market assets. We will talk to Elena Theodorakopoulou, emerging market debt portfolio manager at Manulife Investment Management. Really interesting EM dimension on that broader debt market story, bond market story that we've been discussing. Are we moving from inflation to growth concerns? We'll talk about that with her. In the meantime, let's have a quick check on where we are on futures then, Lizzie. European futures pointing lower still, not perhaps by as much as they were.
No, but we are positive now stateside. S&P E-minis and Nasdaq futures both up 0.2%. Plenty more to come. This is Bloomberg.
Welcome back. This is the opening trade, Monday, the 30th of March. Let's have a look at the futures picture then. And European equity market futures looking to factor in some of the negativity that we saw stateside later in the day on Friday. So that is still relevant. We add into that the signs of escalation that we've seen then in the Middle East over the weekend. And all of that adds up to a sort of negative sentiment picture. And certainly, Lizzie, we see oil prices going higher. But I know you're about to go through what's going on bond markets. And I just wonder whether slightly lower yields could be a positive for global stocks.
Well, indeed, we are seeing lower yields both in the US and now at the start of the European bond session across the curve, across the continent, as we see investors pivoting from concerns around inflation, perhaps more to growth. So that on both sides of the Atlantic.
Yes, and our colleague Adam Linton, who we'll talk to later, saying that European natural gas futures have opened higher, but they're not bolstering hawkish ECB bets, which marks a change from what we've seen earlier on in this conflict. So that's certainly something we keep in mind. Taking a step back, let's talk about emerging market assets and where we've been on that story. So EM assets have been under pressure from the war in Iran, with EM stocks down about 10% this month. Local currency bond yields are at a 2-year high, and some currencies have fallen more than 5%. But just as the conversation in wider bond markets has turned to concerns about economic growth, some investors are now seeing opportunities in EM debt alongside that story. So joining us now is Elena Theodorakopoulou, who is Emerging Markets Debt Portfolio Manager at Manulife Investment Management, and joins us now. Elena, nice to have your perspective. So taking a step back, we have seen a lot of pressure on EM debt as a result of oil dynamics, FX dynamics, inflation concerns then for emerging markets. Where are we now? Take stock for us. What does the emerging market debt story look like to you?
Well, good morning, everyone, and good evening, good afternoon to our Asian colleagues and peers. As you said, as you rightly pointed out, Anna, it's quite a few things happening, and it is something that has been quite troubling for risk, and EM is quite inclusive of the sentiment that has been carrying forward. Don't forget, we're just starting the last week of the first quarter, and March in itself has been quite troubling for very obvious reasons. We are all quite versed in geography, and we do know that physical pipelines can get us that far. So naturally, with the disruption that we have been seeing from the geopolitical developments, there have been some places in the world that have been feeling more the adverse impact of what's been happening. You mentioned downgrades, growth downgrades, and it's worth highlighting what we've heard last week from the OECD, that there is a high level of uncertainty around the duration and the magnitude of the current conflict in the Middle East, and that means that growth outlook is subject to significant downside risks that could result in lower growth and naturally higher inflation. So again, EM is not immune to what's been happening now, but again, it's been more resilient relative to what we have been witnessing in previous episodes, for sure.
Yeah, so let me ask you about that resilience, Elena, because even though we've had a tough March for various EM assets, a number of people have been pointing out that the fiscal picture for emerging markets, certain governments in the emerging market space, looked a lot better coming into this war, into this crisis, than it did in previous testing episodes. A lot of self-help measures have been taken, a lot of house cleaning, if you like, when it comes to debt levels. Is that a story that you think emerging markets are now benefiting from then?
Absolutely. It's not just a story, it's the reality of the EM. And that ties to exactly the point that traditionally what you would look into EM is the ability to prevent any sort of capital flight in times of geopolitical tension, as we're navigating at the moment, and policy normalization. What we have been seeing since the end of February and with the geopolitical developments is combination of the two. You have been seeing the repricing of the front end and in terms of hikes in DM, but also it's a natural byproduct that you have been seeing that also in EM. Tying back to the things that we have been discussing about the evolution relative to the previous cycles, another key point is to make that when you compare where we were, for example, 2024, with many central banks, with many of the authorities depleting effectively FX reserves. These days, what you have been seeing, the exact opposite. We have been seeing replenishing of FX reserves, which is effectively a rainy fund, and which is effectively what we have at our disposal in times of stress, of distress. And this is what we have been seeing now put forward in order to be at a better state.
So, Alina, is now the time to buy EM credit and local bonds, or is it better to kind of wait till some more of this volatility has passed?
Hi, Lizzie. And it's actually always the time to buy EM, as long as you know where to invest, as long as you do your homework, and as long as you know what is the state of the business cycle across the different aspects of EM. Don't forget, EM is not a monolith. It is not just one facet of what you're seeing. So naturally, with what we have been navigating, what you're seeing is leaders and laggards. You have been seeing economies that they're more tied to the upside of what's been happening, and equally economies that they're tied more into the shock, the negative shock through their terms of trade impact. So what I would say is, as long as you know where you're investing and what is the risk that you're getting, and especially EM has been an asset class that has been quite underowned and undervalued, then yes, certainly there are pockets that you should explore.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
But how much of the EM debt story right now is about Fed policy? How much of it is about, you know, the sell America trade, the desire to diversify away from US assets?
Well, no one can shy away from what is happening in US. No one can shy away from what is happening in Fed, whether you're talking about DM rates, whether you're talking about EM rates, whether you're talking about sovereign, corporates, local currency exposure. But what we have been seeing certainly is tailwinds, positive tailwinds, especially manifested, for example, in the Asia part of the world through the AI, artificial intelligence, that has been helping a lot and has been offering some buffer on what is happening at the moment. But going back to your point, there is an interlinkage, but certainly there have been discussions about what is the state of the US economy, and certainly it has been proven more resilient than expected. And in EM, equally, we have economies that have been proven extremely resilient, extremely strong. So yeah, to your point, it is an interlinkage, but there are also a lot of idiosyncratic stories that are playing in EM.
And let me ask you about some of the more negative areas of the EM space, Alina. You've talked about the resilience, and you've talked about how there are always reasons to buy if you're selective. Where are the areas you want to avoid? Those with more exposure, I imagine, to the higher energy costs and the strength of the dollar and the weakness of their own currencies. So where would that put the spotlight?
You're absolutely right. The economies that at the moment have to bear the greater impact, the higher cost from energy imports, even when you think into the economies and the countries that they are commodity exporters, energy exporters. At the moment, we're navigating a very particular event where it's impacting not just the pricing, but also the quantity and the ability to export, no matter the demand out there. So it just changes the paradigm. But again, when you're thinking about sensitivity, you would be regionally put it more inclined to be more wary in the places of the MENA region and perhaps into the Asia region where you have energy importers.
Well, let's come back to this point of whether it's time to buy the dip now or if there'll be more outflows, Alina. How much worse does it get for EM if this becomes a longer war and the dollar story just keeps on continuing to get stronger?
Well, by the way that you stated the question, is exactly what you were referring to. If we get into prolonged, even intensification of the developments that started at the back of end of February, you would have been seeing risk coming under pressure, no matter which facet of risk you are thinking. And yes, you're absolutely right. And we had some outflows registered over the past few weeks. Again, it's coming at the back of a very strong beginning of the year, at a very strong last year. And naturally, if we're turning into a more risk-averse world, EM is not going to be immune. That's a fact.
Okay. Elena, thank you for your insights this morning. That's Elena Theodora Kopoulou, Emerging Markets Debt Portfolio Manager at Manulife Investment Management. Well, pivoting to the corporate world now, the chief executive of HSBC says he's ramping up the integration of generative AI into the lender's operations. In an exclusive conversation for Leaders with Francine Lacroix, the podcast, George Eldahari talked about the technology's impact on productivity.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging.
The dream.
170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most, kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers, are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times, and we're not talking
in 12 months.
In 12 months, we're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those, in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
That was the HSBC CEO, George Eldahari, speaking on the new episode of Leaders with Francine Lacroix, the podcast, which is available to download now.
Well, coming up, we'll check in on European oil and gas majors, with Brent topping $110 as the Iran conflict continues to escalate. More on your stocks to watch at the European Open next. This is Bloomberg.
That's what makes this game more unique.
Hey, you all play pickleball?
Tonight.
7. See you later.
To get what you need, same day, the world needs warehouses. Blackstone made the connection early and became the largest private investor in logistics globally. It's investments like these that can help build wealth for your clients.
I think what the Fed's dealing with right now is the triple whammy of deportations, tariffs, and now the war. And so that just adds to the uncertainty the economy was already facing. You know, it's amazing. The U.S. economy has been very resilient, but it's showing real signs of fragility right now, and so the Fed's very worried.
That was the former Philadelphia Fed President Patrick Harker speaking to Bloomberg on the sidelines of the Citi Hong Kong Macro Conference with his views on the vulnerabilities for the global and US economy. Let's turn to the markets now in 3 minutes. On the opening trade, we're joined by Adam Linton from our Markets Live team. Good morning to you, Adam. Monday morning then. And we sit here right now looking at US futures, stock futures that look actually a little positive. European futures negative but improving. They've improved a little bit. Do you see reason for that bounce? Is the fact that we're seeing lower bond yields likely to be one of the reasons why we could see a bounce?
Yeah, I think lower bond yields could potentially be playing a bit of a role. But in terms of like how this week is shaping up, it's always set to be a case of we have this deadline for US-Iran talks next Monday. So what is the tenor of news flow that fills that gap? And if you look over the weekend, we've still seen Iran and Israel exchanging missile fires. We've seen the Houthi rebels enter the war now, which is particularly dangerous for, potentially those Saudi oil exports. Bloomberg Intelligence says that if they're vulnerable, that could add $15 to $20 per barrel to Brent. And then, we're also seeing the additional troop build-up by the US. So the tenor of news flow is relatively negative, and yes, we are looking to see how these US-Iran talks develop, but ultimately the negotiating positions are pretty far apart. I know we've seen Trump try to interject today to say they're going relatively well, but I don't think the market's really kind of buying that at this stage. So all we're kind of really seeing today is, US stocks are higher, but that's pretty much what we've seen throughout the conflict. Every Monday, S&P 500 has closed higher, only for it to close lower at the end of the week, and I don't expect this week to be any different.
But to Anna's point, yields down both here in Europe and in the US. So it seems like higher energy prices aren't boosting ECB hiking bets anymore. Are we at peak hawkishness when it comes to the central bank?
I think it definitely is positive. I think we saw some of this price action start on Friday with the US. We saw that kind of twist steepening move in the curve, whereby front-end yields started falling. I think for the Fed, obviously, it's slightly different. They have dual mandates. They're probably more cognizant of the negative growth implications via the labour market. But like you said, yes, we are seeing European bonds follow suit now. And we saw gas prices, open higher today, but not translate into higher higher rate hike bets. And so I think we are seeing a bit of a breakdown in this mechanical higher energy equals higher inflation equals more ECB bets. And some of that has been aided by the ECB themselves. We saw Villeroy urging patience. Schnabel, who's one of the more hawkish members, she's definitely taken a more measured approach. So I think it's definitely something we are seeing signs of. I think for we will see a bit more data capture this week. We've got the ISM data, we've got March payrolls. So, if those come in soft, then I think we could see an increase in this trend whereby, front-end yields are dragged lower. I think for Europe, though, the back end is still maybe a little bit more vulnerable. I think, we've seen signs of that. We're in kind of higher since territory again for the UK. I think as, European balance sheets are squeezed, having to take supportive measures, this could impact the back end of the European curve as well.
OK, and let me ask about yen intervention, because in the midst of all of this, we seem to have got some commentary from the Bank of Japan that it feels a bit like intervention. Remind us where we've got to on the BOJ story then, Adam.
Yeah, so, obviously with this verbal intervention, they're trying to, it does feel they're pushing against the string a little bit to some extent, because this isn't a speculative move. This is a fundamental driven move given the terms of trade shock from higher energy prices. And ultimately, real rates are still very negative in Japan. So even if you do get BOJ hikes, it's still going to be a difficult position for the yen. If we do see any yen rallies, they'll probably be relatively short-lived.
Adam, thank you very much. That's Adam Linton from Bloomberg's Markets Live team. And remember, you can get up-to-date analysis and insight from Adam and the rest of the team by going to MLIV Go on your terminal. Now, let's turn to our stocks to watch this morning with Abir Abu Omar. Abir.
Good morning, Lizzie. The first thing we're looking at this morning with 9 minutes for the market to open in Europe is oil majors. Now, oil has surged 90% since the start of the conflict in the Middle East, and you definitely see that reflecting into the prices of oil majors in Europe, like BP, Shell, Total. Those are surging for the past month, 22%, 13%, 16%, and 42%, 43% almost. Now, this Brent prices have also gained this morning around $115 a barrel after the escalations that we've seen over the weekend with the Houthis getting directly involved. we flip the board and we see how energy is performing compared with the wider stock 600, and is doing quite well, outperforming other stocks. Now we flip the board to aluminum or aluminium here in London, and Asia aluminum has done quite well this morning, and this is on the back of a 6% surge in aluminum prices this morning after Iran attacked facilities both in the United Arab Emirates and Bahrain. So we saw the Asia session here. Asia aluminum stocks did pretty well. We turn our attention to Europe at the open, and we look at Norsk Hydro, for example, which has year-to-date done quite well, nearly 20% up. And if you plug that against aluminum prices, you'll see that they're quite in tandem. And then finally, a stock that is not very relevant to what is happening in the Middle East, and that is Telecom Italia. Now, we keep a look at Telecom Italia, but also Inuit, and you see the year-to-date performance this morning. One is doing well, one is not doing so well. Now, Telecom Italia has terminated a $2 billion deal with Inuit. That was news that was reported last week, a cost-cutting or a cost optimization process for Telecom Italia. So we take a look at both these stocks at the open this morning and how they're going to fare. Anna, back to you.
Abir, thank you very much. Bloomberg's Abir Abu Omar. Abir was talking there about oil prices, and interesting to add into the mix then, Lizzie, that we've got SocGen out with a new outlook for oil and saying that there is a, quote, growing likelihood that Brent will top $150 on the Iran war. That is not obviously being reflected this morning. We are up 2.5%, but 115 is where we trade on the Brent price. Brent oil may average $125 a barrel in April on the Middle East war. This according to SocGen as well. And they're saying this because they say that the oil market faces, quote, huge draws in inventory, shut-ins. And so this is adjusting the SocGen view. And really it comes on a succession of houses upgrading their views.
Yeah, Macquarie just last week saying that oil futures could hit $200 a barrel if the conflict drags on till June and the Strait of Hormuz stays shut.
Yeah, a bit of a reality check for Europe, perhaps, as we discuss. Asia very much facing up to this already. And what will this mean for Europe and for rationing of any product? Meanwhile, you're watching software stocks.
I am. You could see more downside for European software. It tumbled on Friday. Cybersecurity focus in particular. You've got the SAP at 52-week lows here in Europe. So keep an eye for more of that today.
Yeah, we're also watching Boohoo in the retail space, the clothing retailer, delivering its adjusted EBITDA numbers and raising its 2027 guidance. So that upgrade to guidance could push the stock a little higher at the start of trade. We will be back with the market open. The futures picture has actually been pretty volatile for Europe. US futures now pointing more decidedly positive, up 0.3% on E-minis, and European futures pairing their losses. The opening trade is coming up next. This is Bloomberg.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Welcome back, everybody. A few minutes then until the start of another trading week here for European cash equities. Let's cast our minds back to Friday, because it is some way instructive to see the profile of the US trading day on Friday and how it continued to deteriorate into the afternoon, because it is that weakness that a couple of hours ago we were really expecting to pick up on at the start of the European trading day. We will get some of that, but that is certainly the negative input, or one of them. And then add to that, over the weekend, signs of further escalation in the war in the Middle East. The Houthis entering the conflict, the arrival of more US troops, the attack on certain bases over in Saudi Arabia, and US personnel being injured in the process. All of that adding up to something a bit negative. So what does the futures picture look like then for Europe? Well, we do have a negative slant to futures, but US futures have actually started to pick up into positive territory, and the FTSE 100 isn't far from positive territory right now. So a little bit of negativity coming through here, Lizzie, but we've seen this being paired a little bit, and I just wonder whether the fact that we've got slightly lower bond yields this morning, whether that is something that maybe reduces the panic stations when it comes to European reaction functions.
Well, in terms of some of the stocks to watch this morning, Anna, we can start with the impact of the Middle East war. We had, of course, Tehran over the weekend striking aluminium producers in Bahrain and the UAE. So we watch aluminium stocks here in Europe because we've seen futures on the LME surging nearly 6%, the most since 2024 this morning after those attacks. So keep an eye on the likes of Norsk Hydro and Grangers, as well as other miners involved in the metal like South 32. Also keep in mind European software stocks after that space tumbled on Friday, a particular focus on cybersecurity, and then Boohoo in your retail space. They had results out this morning exceeding guidance when it came to EBITDA, so keep an eye on that as well, Anna.
Yeah, a bit of a stock-specific news there to focus in on, but the broader picture then, Lizzie, is perhaps a negative one for European stocks then this morning with those inputs of escalation and the negativity around US stocks on Friday. All of that setting us up for something a little bit weaker. Is that going to be cushioned by the fact we see those lower bond yields and the bond narrative pivoting from one where we're concerned almost exclusively about inflation to one where we're concerned also about growth? That means slightly lower yields, and does that change things for the banking sector perhaps here in Europe? So we wonder how the banking sector is going to perform with that in mind. European equity markets then are open, and either side of the flat line then, the FTSE 100 just into positive territory, up 0.1% or so. The Stock 600 more broadly down by 0.2%. The IBEX down by that kind of amount. The CAC 40 down by that kind of margin as well. So broadly a little bit of negativity still coming through as we watch those signs of escalation in the Middle East and a higher oil price as a result, Lizzie.
Well, let's turn to the breakdown sectorally. You have just under half of sectors in positive territory this morning. Basic resources leading the gains, up 0.9%. Energy not far behind, up 0.3%. But bottom of the basket, as you flagged, Anna, banks today down 0.8%, perhaps connected to those yield moves that we have been seeing, yields lower as concerns pivot from inflation to growth off the back of this conflict. We'd flagged that we should be watching the aluminium stocks this morning. Grangers is down 0.6%, waiting for Norsk Hydro to open. But in terms of the energy space, the likes of Total, BP and Shell all in the green at the moment. Just looking at some of the other miners this morning, BHP negative, Anglo-American negative, but Rio Tinto with that big aluminium connection up more than 3%. As things stand. Just some of those other stocks to watch that we had been flagging. Boohoo up 5.25% right now. Telecom Italia down 0.25%, and in your software space, SAP indeed up 0.7% after the drop in European software over on Friday.
Yeah, it's interesting, the banking sector, isn't it? Because the fact we saw those higher yields coming through in recent weeks didn't support banks necessarily, because a lot of people said it was the wrong kind of inflation and that wasn't going to be positive for the banking sector. And now we see those yields weaker, and that's not great for the banking sector either, it would seem. And so that is the worst performing sector this morning. You mentioned basic resources. That is where we see the positivity, and so that speaks to the strengths of London, doesn't it? The Brent price, interestingly enough, is actually a little stronger than it was just half an hour ago. So up by 3.5% on Brent, up over $116 a barrel again. And that is positive, of course, for some of the oil majors. And Norsk Hydro, with aluminum prices in mind, up by 4% this morning. So it is some of the basic resource and energy stocks that we see going higher. Let's talk to Richard Saldana, who's Global Equity Portfolio Manager at Aviva Investors, and joins us on set this morning. Richard, nice to have you with us. So another Monday where we're taking stock at the weekend, working out whether we've seen, to what extent we've seen escalation over the weekend. Oil prices are firmly higher this morning. How does the world look? The equities are your focus. So what does the equity market universe look like to you this Monday?
Yeah, it's interesting. I mean, we've had what feels like a number of manic Mondays so far, but actually the initial sort of market reaction, as you said, actually feels reasonably calm given what we've seen over the weekend. As you said, signs of further escalation, Houthis now entering the conflict, US troops mobilizing, as you highlighted. Look, I think from our perspective, just taking a step back, it feels like we are entering another phase now, particularly now we're 4 weeks into this conflict, no clear sign of an end in sight, and actually what does even an end game look like at this point? So look, I think obviously from the starting point where markets were pricing in a relatively short-term conflict, in this, talking weeks here, I think now there is potential for this to extend for months now. The market is having to reflect on that. So I think as we start to enter that new phase for equity markets, this starts to shift in our mind from what we've seen so far, which has actually been, you could argue, a relatively ordered, more of a degrossing from an equity allocation perspective to more of a de-risking.
Yes. Tell me a bit more about that, because degrossing then, so reducing the size of positions rather than necessarily reducing the risk profile on those positions. So what does it look like to go from degrossing to de-risking? What should we expect to see more of?
Yeah, absolutely. So if you think about the degrossing phase, which is really what we've seen so far, that's been more about selling the recent winners and buying some of the recent losers, right? So if you think actually the recent winners actually coming into this conflict were actually sectors, sectors such as the consumer staples, healthcare, utilities, etc. More of those kind of, call it, old economy stocks. We saw that halo trade in February worked quite well when everyone was fearful about AI disruption, and actually some of the software names benefited in this degrossing phase that we saw so far. As we start to shift more from the degrossing to the de-risking, in our mind that becomes more of a beta trade, right? So you start to think about those more traditionally defensive sectors, i.e. staples, i.e. healthcare, that actually didn't perform quite so well or not quite as defensive in the degrossing phase, actually we think start to become more defensive and resilient in the de-risking phase. And then on the flip side, it's going to be those more cyclical sectors. You've highlighted the banks so far this morning, clearly struggling somewhat, and those, call it more discretionary sectors, consumer discretionary sectors, industrial names, again, you think about the kind of raw material costs as well there. So again, we think that's probably what the playbook looks more like in a de-risking phase as opposed to degrossing.
How useful is the 2022 playbook? Evidently, the economic backdrops are completely different, but is there anything that you would copy and paste from then that is useful now?
Look, every single phase is different, right? And I think you're right. I think 2022, that window is instructive somewhat. I think, as you highlighted, some clear differences there, particularly when you think about the starting point where central banks were back in 2022, where rates arguably were at pretty low levels, right? And then you think about where inflation was in 2022, actually at sort of relatively elevated levels compared to where we are now. So you could argue rates in a more kind of neutral perspective right now, inflation actually more relatively under control compared to where we were in 2022. But look, there's no doubt about it, a prolonged energy shock, i.e. oil prices above $100 for an extended period of time, i.e. months, 2022 does offer some insight, I think, again, when you think about some of those sectors, some of those more traditionally defensive sectors, whether it be utilities, telecoms, consumer staples, healthcare, etc., that perform well, obviously, as well as energy stocks that we have seen so far have performed well. And as I said, those more discretionary sectors struggling somewhat. So I think 2022 investors should have that somewhat in their mind, but as you highlighted, some clear differences in terms of the economic backdrop.
And would you have expected the FTSE 100 to outperform the Stock 600 more, given the exposure to energy? Or have you been surprised by how aligned they've been since the start of the conflict?
Look, somewhat. I think when you think about the composition, particularly the FTSE 100, you think about the big energy stocks, whether it be BP, Shell. You also think about actually some of the more traditionally defensive sectors, i.e. some of those big, healthcare names, whether it be the likes of AstraZeneca, consumer staples names. But I think it's been more, as I said, that degrossing phase where actually some of those sectors that are big heavyweights in the FTSE 100 have not actually proved so defensive. Now, we do think if we're shifting to a period of months for this, that actually starts to play more better. But also we have to factor in somewhat the UK also in a position of weakness. Clearly, if this is a prolonged conflict, and when that feeds through into inflation and obviously energy prices and the energy dependency of the UK clearly also comes under pressure somewhat as well.
Yeah, and maybe that shows up more in the 250 then than the 100 being more of a reflection of the UK economy. Thinking of 2022 and the extent to which that is a useful benchmark to look back at, we talked a lot then about pricing power, and actually stocks didn't do as bad as people thought they could do because of the amount of pricing power they have. Now, the inflation backdrop maybe is a little different this time around. Is that instructive? Is that something we need to think about?
No, I think you're absolutely right thinking about it in that pricing power terms. And to be fair, in 2022, particularly as we thought about coming out of those COVID, supply shocks, actually companies were in a pretty good place when it came to pricing power. So if you think about, obviously, the inflation impact was large when you think about it from a raw material input cost perspective. But actually companies in 2022 were able to pass those on. So actually what you saw, if you think about European equities in 2022, from an earnings standpoint, actually didn't really budge. It was more of the derating that you saw, was the valuations that took the hit. But a lot of that was the ability to pass through those pricing pressures. Now, I think here there may be signs where there might be a little bit more challenge when you think about where the consumers right now and the squeeze a consumer is likely to face from those higher energy costs. But I think at the same time, there will be sectors where we still think that pricing power, or that ability to absorb some of those inflationary impacts is still there.
What do we need to hear from US President Donald Trump to calm the equity market at this point? Genuinely,
Yeah.
if he were to say, and we were discussing this earlier, if he were to say there will be a ground offensive, but it'll be limited and it'll be short, would that support the equity market?
Look, I think a ground offensive, I think in my mind, wouldn't be taken particularly well by the market so far. I mean, I think, look, the reality is we've heard lots of, obviously, noises coming out of the US administration. We've heard, obviously kind of, noises on the other side from Iran. I think really what the market needs to see, other than obviously the signs that there are talks taking place right now, it's really going to come down to when is that Strait of Hormuz going to reopen again? Because, again, that is really what is the choke point right now when you think about it from an energy price perspective, but also from a global economy perspective. So talks are well and good, noises are well and good, statements are great, but ultimately we want to see a sign of that strait reopening again. And I think ultimately that is what the equity market is going to need to see. And it's interesting, actually, we've seen, obviously, last week on Monday we had that statement. We saw, obviously, markets pushed significantly higher, oil prices came down. I think that reactionary function to that is somewhat diminishing, I would suggest, because really what markets want to see are those channels reopening again, allowing that flow of oil to come through, and that ultimately will ease those pressures that we're seeing right now.
In the meantime, Richard, if we're not seeing that just yet, what does it mean that the bond market story seems to be pivoting a little bit from focus on inflation and higher yields to a focus on growth? And we don't want to draw too many conclusions about just one day, but today we are seeing slightly weaker yields as if markets are now focused a bit more on the growth impact of this. What will that mean for stocks?
Yeah, so look, I think you're absolutely right. Look, we've seen some significant moves in rates markets, right? We've gone from pricing, cuts here in Europe and particularly in the UK to pricing in hikes now as people go, central banks need to kind of fight this inflationary fire, as it were. Now, I think, as you said, we're shifting more from it being an inflationary shock to also people thinking about the growth dynamic. And I think ultimately for equity markets, we've seen that doesn't tend to be particularly constructive when we think about it, if people are starting to worry more about the growth aspect. As we've seen in prior periods, look, equities can absorb $100 oil if it's a short-term impact. But once you start getting into month-long impacts of $100 oil, we've seen equity markets do tend to struggle somewhat in that. So again, for central banks right now, all eyes are going to be, obviously, they're walking the tightrope somewhat in trying to manage what could be a transitory impact to what actually could end up being quite a shock to growth.
Richard, good to see you. Richard Saldana there, Global Equity Portfolio Manager at Aviva Investors. Thank you. Well, let's check in on the core six now, shall we? How are they faring this morning? Against this backdrop, we have LVMH and Nestle gaining, but the rest are in the red. Particular losses for Schneider Electric this morning. Many, Anna, had been saying that this could be a time to get into consumer staples at this point in the conflict, and Nestle indeed outperforming up 0.4%. Let's now check on some of the individual stocks on the move with Bloomberg's Abir Abu Omar.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Good morning, Lizzie. We are turning towards oil majors. Like I mentioned in the previous segment, oil prices are now, or Brent prices are now close to $116 a barrel, gaining slightly over the past few minutes. And that has led to, and the weekend's events as well, have led to a surge and a gain in the oil majors here in Europe, as much as 2.2% in the case of Equinor. And this is on the back of the Houthis getting involved over the weekend directly for the first time since this conflict in the Middle East has started, but also President Trump, or the Wall Street Journal, reporting that President Trump is considering troops on the ground in Iran or in the Middle East. This has led to a surge in Brent. We move on to aluminum, and aluminum prices surged as much as 6% this morning before pairing some gains, but that has led to a gain in the Asia aluminum session, but also so we're seeing that reflected in Europe with the likes of Norsk Hydro up over 6.4%, nearly 6.5% this morning. And this is after Iran attacked facilities both in Bahrain and the United Arab Emirates with significant damage to those. We turn to a different story, and that is Boohoo, which is also doing quite well this morning, nearly gaining 7%, and this is on the back of some favorable results that were reported. Investors are looking favorably at that news, and this is doing well in the space of fashion. And then we turn to Inuit, which we spoke about earlier as well. Inuit and Telecom Italia are doing different things, diverging this morning, and this is after Telecom Italia said that it would terminate a deal with Inuit valued at over $2 billion this morning, cost-cutting, a process of cost-cutting for Telecom Italia. Inuit not doing well on that news. Telecom Italia gaining progressively as the session moves on. And then finally, the last talk we turn to, we go back to those Middle East stories, and that is Lufthansa not doing very much now, actually pairing some of those gains as I speak, and this is on the back of some strikes by the company, which has cabin crew has agreed by large in favor of strikes. But just when it comes to airlines, this is a sector that was not doing very well at the start of the war and going into the end of this month as jet fuel prices, Lizzie, really gain on the back of the closure of the Strait of Hormuz, but also the wider tensions in the Middle East. But this is what we're looking at. Back to you.
Okay, Abir, thank you very much. That's Bloomberg's Abir Abu Omar.
Let's talk about some of the broader take on the markets, I suppose. Abir going through some of the detail there, Lizzie. The Stock 600 actually just into positive territory, which marks quite a rapid turnaround from a few hours ago when we got into the office. The futures picture for Europe looked decidedly negative. No surprise, given Friday's session on Wall Street and all of the escalatory signs over the weekend and the higher oil price. But actually, that higher oil price is acting as a bit of a support today. And higher aluminum prices also a support. Basic resources stocks, the highest or the best performing sector as a result.
And the FTSE 100 outperforming as well, carrying Europe really. We're just flat to the upside, but we are adding to gains for US futures as well. S&P E-minis up 0.3%, and same for Nasdaq futures as things stand. Well, coming up, oil prices gaining, as we say, as the Iran-backed Houthi militant group in Yemen enters the war in the Middle East. We'll get more on that next. This is Bloomberg. Welcome back to the opening trade. 18 minutes into today's session, and the Stock 600 is back in the red. Stock sliding for a third day here in Europe as we have higher oil prices. Brent now trading at $115 a barrel, up 2.8% off the back of the latest in the Middle East. We'll get to that in a moment, but because of the higher oil prices, you are seeing outperformance here in London for the FTSE 100, Anna, up 0.1%.
Yeah, absolutely. So that's the upside for stocks. Upside for oil evident this morning. 115.81 is where we trade. That's on Brent. Oil gaining today as the Iran-backed Houthi militant group in Yemen enters the war in the Middle East. The escalation comes as US troops arrive in the region, with energy markets expecting further potential for chaos as the conflict continues to expand. For more, let's bring in Bloomberg's Middle East energy market reporter Anthony De Paula, who is with us from Dubai. And Anthony, over the weekend then, a lot of comment about the fact that the Houthis have joined the conflict, and this could have an outsized impact, I suppose, not necessarily because of their military capabilities, but just geographically where they are located and how this will continue to have an impact, or maybe a stepped up impact, on the flow of crude out of the region.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth. And unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Good morning, Anna. Yeah, that's correct. The Houthis came in this weekend saying that they were entering the war, launching a missile at Israel. So there is a heightened risk there, but what we haven't seen yet is a real declaration from the Houthis that they are going to act in terms of trying to block or interdict shipping in the Red Sea. And as they've been doing up until the last few months, launching missiles, drones, even some small vessel attacks on ships going through the Bab el-Mandeb Strait that runs south from the Red Sea. And that is important because that would be the...
When do you usually do it?
Oh, we seem to lose our connection to Anthony. That's unfortunate. We were just in the context, we were just having a conversation there with Anthony about oil prices, about the involvement of the Houthis and what that will do. The East-West pipeline, of course, seen as a way, this is through Saudi Arabia, seen as a way of cushioning the blow for the global economy from what's been going on in the Persian Gulf. But with the Houthis entering the fray, maybe that is not the case. Let us pivot from that to a conversation about what's going on. In fact, it seems Anthony is back with us. Anthony, I hope you can hear us. Maybe we'll move the conversation on to what President Trump has been telling the FT, that he wants to take the oil in Iran, and commenting on Karg Island. What do we make of these latest comments?
Yeah. Hi again. Glad to be back. I was also going to say that I think that it's more the uncertainty around what's going to happen going forward that's moving oil prices today. Rather than kind of those comments from the Houthis this weekend, because as you mentioned, we hadn't seen that comment from the Houthis that they were going to really have an impact or start attacking the oil flows out of the Red Sea. But I think what traders are talking about this morning is what's going to happen going forward this week with the U.S. Will the U.S. forces try to take Karg Island? Will they do some action perhaps around Hormuz to try to open that? So traders are really watching the movements of U.S. troops, watching, of course, the comments of President Donald Trump, which seems to say both things and everything. So it's difficult really to gauge from his comments what he's going to do. But you're watching what's happening with more troops coming in and kind of where the strategic nodes are, being a Karg for the Iranian exports as well as around Hormuz. So I think that's what traders are really kind of focusing on this week, with added risk of additional intervention and that doubt as to how those peace talks are going on. So we've got those two tracks going on at the same time, and that's really what seems to be occupying the traders this morning, Anna.
Anthony, thank you for the context. That's Bloomberg's Anthony de Paula there out of Dubai. Well, as prices for oil skyrocket, worldwide growth forecasts are being slashed and critical fuel shortages are paralysing nations from Pakistan to Thailand. In South Korea, the government is now weighing drastic driving restrictions to insulate its energy reserves from that escalating conflict in Iran. For more, we're joined by Bloomberg's Jill Desis out of Hong Kong. Jill, good morning. What's been the impact so far in Asia as the Gulf suppliers cut output?
Hey, good morning, Lizzie. Right. So, there's the South Korea measures that you just mentioned. So this is something that Seoul has already implemented for their public sector employees, basically scanning license plates to kind of prevent the number of times that you can access government buildings. They're actually considering expanding this to the private sector as well. That would be, Lizzie, the first time that such driving restrictions would be in place since the Gulf War, so more than 30 years ago. So that kind of gives you that idea of how drastic things have really kind of become. But it's really not just South Korea. You've also seen measures announced across the rest of Asia Pacific today. Australia, for example, the Prime Minister, Anthony Albanese, came out and talked about implementing a tax cut for fuel because they're trying to drive down petrol prices there. That's the first time we've seen something like that since 2022, when, of course, we saw Russia's invasion of Ukraine push up oil prices worldwide. So you do have some concerns there as well. In 2022, those types of measures lasted for 6 months. So far, we're looking at a 3-month tax cut here. And then, of course, you've also got, just the measures that have been in place across the region over the past several weeks. So in the Philippines, implementing some work from home restrictions for private sector or for public sector employees. So again, just that kind of measurement there. You've got some increases to various ferry fares and things like that in Thailand. So again, really hitting the region pretty hard.
Yeah, absolutely. And so you wonder how much Europe is going to have to pay attention to what is happening in Asia and think about at least the possibility of some of these measures. Meanwhile, then, Jill, what signs are we getting about Chinese cargoes going through the Strait of Hormuz? Because maybe that offers a little bit of relief.
Yeah, so this is interesting. We actually were just analyzing some vessel data, looking at a couple of Chinese tankers that appear to have delivered more than 260,000 barrels of diesel to the Philippines. So as I mentioned, the Philippines being one of those nations where you are seeing some of those austerity measures. And in fact, we haven't heard full disclosure exactly on these vessels or anything like that, but that does kind of track with this idea that China is, offering some diesel to some of its neighbors in kind of a bid to help ease some of the supply crunches, because as we know, China is one of the only nations that's really been able to get some vessels through the Strait of Hormuz at this time. But yeah, again, does indicate to you that when it comes to several places around Asia Pacific, they're dealing with these really big supply crunches, and it does seem like maybe there's at least some temporary relief there. But as we all know, I mean, the longer this goes on, the more difficult it is to really kind of envision what a lot of these supply crunches are going to look like long term.
Jill, thank you very much. Bloomberg's Jill Decis there with the latest on how Asia is responding to this current crisis. Meanwhile, the likes of SocGen talking about $125 oil and beyond. It seems that higher oil prices are something that the markets are starting to take really seriously.
Yeah, what I'd like to know is these thousands of US troops, how many of them would it take to take Kharg Island? Just going back to what Anthony was saying, and how many would it take to try and reopen the Strait of Hormuz? These are two, is it an either-or situation? Interesting to work out what those troops could be for. And we're going to talk about geopolitics next. No end in sight to the war as it enters its 5th week, with strikes continuing across the Middle East. Perhaps we can get the answer to that question with Lindsay Newman, visiting research fellow from King's College London. She's coming on next. This is Bloomberg.
Welcome back. This is the opening trade Monday morning, 30 minutes into our session here in Europe. And we had anticipated a negative session for European stocks. At the start of it, though, it looked a little more resilient. Today, we are still flatlining, essentially, across European stocks, but we're just dipping a little further into the red than we were just 15 minutes ago. The FTSE 100, yes, that's still in positive territory, up by 0.2%. Energy stocks, basic resource stocks. Lizzie, you'll talk about that in a moment, no doubt. But that is one area of cushion. But elsewhere, we do see some negativity, in particular around the DAX. That's down by 0.2%. In terms of the underlying dynamics then, Lizzie, what are you seeing?
Well, it's quite a reflection of the fact that it is Easter week, Anna, and it's Monday of Easter week. Volumes down 41% this morning, but a pretty fair balance between members higher and lower on the Stock 600. More to the downside, reflecting that slightly risk-off mood that you were seeing in the geographical breakdown. But let's take a look at some of the leaders and laggards this morning, shall we? Because if we come back to the latest on the ground in the Middle East war, we have seen strikes by Tehran on Middle Eastern plants for aluminium, and therefore you're seeing Norsk Hydro and Rio Tinto gaining as aluminium has surged as well. We're also seeing Xauusd higher more than 5% this morning, this after it was raised to buy at Bank of America. But flipping over to the laggards as well, an individual story for Delivery Hero down more than 6%. This after Prosus is said to be mulling selling its 10% stake in the delivery company. We also have TUI down 1.2%, EasyJet falling as well, as we have those higher oil prices weighing on the airlines this morning, Anna.
Let's get up to date with some of the other news flow we're covering this morning then, Lizzie. And the ECB Governing Council member, Francois Villeroy, says the central bank is prepared to act to rein in inflation expectations. The Bank of France governor told La Stampa the Iran war could inflict a negative supply shock, incurring slower economic growth and faster increases in consumer prices, though he added that betting on dates for potential interest rate hikes is premature. The UK Chancellor Rachel Reeves will urge G7 partners to boost domestic energy supplies and warn the recent surge in oil and gas prices is playing into Vladimir Putin's hands. Reeves will speak with finance and energy ministers and central bankers in an online call later today. We're told she'll ask for allies to ramp up investments in renewable energy and nuclear power to wean themselves off.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Gas. And President Trump says Tehran has given in to most of his administration's demands. But the nature of any direct negotiations remains quite unclear beyond messages being exchanged via third parties. Iran has rejected a 15-point proposal and disputed the U.S. president's claims about negotiations. Earlier on Sunday, President Trump talked of seizing Iran's oil resources, a move that would mark a major escalation in the conflict. Lizzie.
Let's get some analysis now on the latest in geopolitics. We're joined by Lindsay Newman, visiting research fellow over at King's College London. Good morning to you, Lindsay. Thank you for making time for us this Monday morning. We were discussing how the US has sent thousands more troops to the Middle East over the weekend. Do you genuinely believe that the US is gearing up for a ground attack, or is it just that the US is keeping its options open?
Thanks, Lizzie, for having me. You know, I'm a big believer that when Trump moves personnel, when he produces an executive order, when he tells you what he's about to do, he's probably going to do it. The movement of thousands more Marine expeditionary units. We're now at 50,000 military forces in the region, which is about 10,000 more than generally are in the region for the U.S., suggests that something is coming. Now, what that is the big question. But here's what I want to tell you, Lizzie. The big risk is that the status quo, as it currently stands, is not sustainable. Despite Trump saying that Iran has given in to those 15 points in the plan, Iran is continuing to wreak havoc on the region. We saw this over the weekend with targeted strikes on Saudi Arabia and Kuwait. Iran has learned through this conflict that even though there's asymmetries in might and capability in military power, that it can export the conflict not just to the region, but with knock-on effects on the global economy. So leaving Iran as it currently stands means that Iran would potentially have learned a lot of lessons in this conflict, although quite degraded, and would be a more volatile, more potentially dangerous actor, at least for the region, if not the world. So there must be more coming in terms of how to reconcile this tension.
OK, we could come back to the diplomatic efforts, what there are of them. But, Lindsay, when we look at those troops heading there, already there in the region, I wonder what you think the most likely purpose for them will be. Will it be occupying Karg Island, as Trump said to the FT yesterday he wants to do? He wants to take the oil in Iran, in his words. Or do you think that they're more likely to be used to reopen the Strait of Hormuz?
Well, we know that the administration is considering a range of options. There's always a spectrum of potential options that they are going to be considering, all the way from, as you said, restarting the diplomatic talks in earnest, to declaring victory and just going home, down the line to the most likely, most costly option would be for troops to go into Iran and look to actually seize that enriched uranium. There's thousands of pounds in enriched uranium. They're believed to be at multiple sites across Iran, from Natanz and Isfahan. This would not be a sort of simple, quick in and out operation like this type of military personnel have recently undertaken in Venezuela. This is not a 38-minute operation as we saw there. This is going to be a multi-day operation. So that would be incredibly costly, incredibly dangerous. And we know that Iran is very well aware that this is something that the U.S. administration is looking to potentially pursue. So the most likely scenario here has to be something along the lines from a blockade of Karg Island to potentially efforts to bomb and disrupt the resources there to prevent further exports, Iran control over the exports from Karg Island. But again, the U.S. has not ruled out going all the way down the line to seizing that enriched uranium, and Trump has said for himself that is what he wants to do, seizing that dust, he calls it.
Lindsay, what can you tell us about the status of any talks that are taking place? I mean, clearly messages are getting through from one side to the other, but we know mostly about that via intermediaries, the exchange of the 15-point plan from the US side, and then Iran pushing back with its own 5-point plan. And it doesn't seem from the outside that there is much meeting of minds on that front. I mean, Iran talking about wanting reparations, about wanting de facto ownership, control of the Strait of Hormuz, which do not seem likely to be things that the US would go along with. What do you make of the status of talks?
Yes, Anna. So we know over the weekend, non-combatant participants held talks in Pakistan. So Saudi Arabia, Turkey, Egypt met in Pakistan to have conversations about mediation efforts. But those are, of course, indirect. We know, as you have mentioned, that last week the U.S. has delivered this 15-point plan. Iran has said, we're not interested in that 15-point plan. Here's our counterpoints. This is a bit like Groundhog Day. If you remember back to just before the conflict started a month ago, the two sides were in these indirect and direct conversations, and even then they could not even agree about what they were willing to talk about. Iran has consistently said that its missile program and its enrichment program is not on the table. Well, this is exactly what the U.S. has always said that it needs to have on the table. So the idea that these two sides are going to reach some sort of ceasefire or some sort of mediation without further pressure being applied on Iran, it seems very, very low likelihood. And this is why, we're thinking that there is going to have to be some sort of further force and force posturing deployed, as Lizzie and I were discussing, in order to sort of further extract pressure on Iran to drive it back to the negotiation table. Because for right now, Iran feels as though it's quite emboldened. It feels as though it can make these demands because of what we're seeing in the Strait of Hormuz and because of the threats and risks to the Red Sea, which people are incredibly worried about, and I think rightfully so. We see during this conflict that supply chains and energy markets can be a strategy, a target of war now.
Yes. So we're seeing Iran flex its muscles and use those levers of control that it has. Meanwhile, Lindsay, I wonder what you make of the extent to which we have seen regime change in Iran, or the extent to which we've not. I mean, we're just hearing from the Tasnim news agency in Iran this morning saying that the IRGC naval commander has been killed. That name then added to a list of Iranian leaders who have been killed as a result of the Israeli and US action here. To what extent have we seen regime change or not? Is that still pending?
Yeah, Anna, we know over this weekend that President Trump says that we've already seen regime change. Actually, we've seen several regime change, if you follow what Trump is saying. And what he's pointing to is a personnel point, but that is not a structural point. So absolutely, from the Ayatollah on down, we have seen personnel removals that the U.S. and Israel in particular have targeted the regime personnel. But the regime itself, for all intents and purposes, for all we know, remains in control of the country, is directing the conflict strategy. We know that the country itself is under an almost complete internet lockdown. So very little is coming from the country itself. But to suggest that we are already in a regime change scenario, I think is ambitious. I think it's not actually appropriate language. We have seen personnel shifts, but we have not yet seen the regime collapse or regime change. This is a regime that is very much continuing, by all counts, to execute a strategy that was set before the Ayatollah was killed, even as it has seen massive personnel degrading, and those 11 11,000 attacks within the country, 11,000 strikes that the U.S. has imposed on the country itself. So we're not yet in a regime change scenario. Doesn't mean that we may not one day get there. But for now, I think that's inappropriate language to apply.
From 50 years ago to today to tomorrow, CIB has always been here. Growth, innovation, and setting the standard for half a century. Progress driven by quiet mastery.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth and unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
And Lindsay, Gulf allies are reportedly frustrated here, both at the lack of apparent lack of strategy from President Trump, but also privately questioning American security guarantees. How significant is that for US influence in the region? Could that frustration start to reshape alliances in the Middle East?
Lizzie, I think what we're seeing here from the U.S. administration is that the U.S. administration wanted to achieve certain objectives around the missile program, around the naval program, around the nuclear program, and then it has had, because of Iran's response, has had to make some adjustments. And now, so for example, the Strait of Hormuz and reestablishing deterrence over the Strait of Hormuz has now vaulted to the top of the list. And so the U.S. is now struggling with what cost it's willing to pay in order to achieve these objectives. And we know back at home in the U.S. that 3/4 of Americans are worried about the U.S. getting too involved there. So what that means is the signals coming out of the U.S. are quite difficult to read. And for its Gulf partners, that means they're left wondering, well, are we going to actually see the U.S. continue through this operation, or are they going to back away? That obviously leaves them feeling quite unsettled, quite nervous. But most of that is coming from actually Iran's strategy itself. The fact that Iran has decided to pursue horizontal escalation and make the conflict not just Iran's problem, but the region's problem. I think that these partnerships, these alliances are deeper than just this conflict. They're economic, they're in terms of supply chain. You know, the U.S. under President Trump has worked very hard over this administration and its first administration to deepen those relationships. So I wouldn't think that this operation itself is going to damage those relationships. And if anything, it's shown to regional partners that the U.S. remains the most sort of impactful security superpower in the world. That's what we're all seeing from this.
Lindsay, thanks for your analysis. Good to speak to you. Lindsay Newman, Visiting Research Fellow at King's College London. Coming up then, Iran-backed Houthi militants have entered the Middle East war, as we've just been discussing, raising concerns about the threat to shipping in the Red Sea. Of course, pre-existing concerns, reigniting concerns around the Red Sea. We will talk more about that next. This is Bloomberg.
They've agreed to send 8 boats 2 days ago, and then they added another 2, so it was 10 boats. And now today they gave us as a tribute, I don't know, I can't define it exactly, but they gave us, I think out of a sign of respect, 20 boats of oil, big boats of oil.
President Trump speaking aboard Air Force One there. It does seem that volumes going through the Strait of Hormuz still firmly reduced compared to what they were previously. Some of the Chinese and Pakistani shipments, according to our reporting, managing to get through. But let's talk about disruption to global trade. The Houthis' entrance into the Iran war adds further complications to global shipping and supply chains, already dealing with the blockage of the Strait of Hormuz. With the Hormuz and Bab el-Mandeb straits compromised, tankers are diverting around Africa, skyrocketing costs and transit times. Let's bring in our trade czar, Brendan Murray, who's been tracking the trade story for us and can talk us through some of the latest here. So, Brendan, how much does it complicate things that the Red Sea, now we could see tensions there, the Houthis entering the conflict, of course, and that brings in the Red Sea. But the Red Sea wasn't deemed to be fully passable even before this war started, was it? So what difference does it make to the global sort of shipping narrative?
Yeah, well, it just adds to the overall cloud of uncertainty surrounding the ability to ship goods through the Red Sea, the Suez Canal. The Houthis, have harassed shipping since late 2023. They had kind of gone quiet for a while, and some of the container shipping lines were even talking about coming back through the Red Sea a couple of months ago. But of course, since the war started on February 28th, they've started going back around. So the big question is, to what extent will the Houthis start to affect the shipping lanes? Again, in the energy sector, we've seen the Saudis come up with this workaround to pipe their oil across to the west coast, to Jeddah, and try to export it that way. So the question is, will the Houthis try to prevent that energy supply from reaching markets overseas?
And while you've got so much disruption a month into this war, how's the port ecosystem holding up? Yeah,
it's a really complicated one. Number one, because the air cargo, marine cargo, and road cargo are all sort of tied together, and you've got restrictions in air cargo capacity still. There's still some airspace that's closed, and the carriers aren't running at full schedule. You've got Jebel Ali, the biggest port outside of Asia, that is operational, but there's no volumes flowing in and out of there because ships can't come and go. And so that's creating the opportunity there for the port operators to try to work with other ports in the region to get containers flowing from these other ports. But we saw over the weekend that a port in Oman was hit by a projectile, and Maersk said that was going to be out of commission for a couple of days. So you've got this kind of whack-a-mole situation going on where the workarounds are starting to become the targets, and some of those targets are increasingly becoming industrial assets. We saw the aluminum smelter get hit over the weekend. So the war is widening not only geographically but in segments of the economy.
Yeah, Maersk saying that impact of the incident is going to be limited, and Maersk shares actually up 1.5% this morning.
Yeah, which sometimes trades off the pricing, doesn't it? That longer route around Africa, if that's more likely, they charge higher prices, and then they make more money that way. Let me ask you about how this is widening to other commodities as well. So you've talked about how this is widening in terms of targets. We've gone from just targeting military to now industrial, and questions over energy, of course, with the truce on that front from President Trump getting an extension. But in terms of widening the commodities being affected, aluminium then is now in focus. Fertilizers, a lot of talk over the weekend about what this does to global supply chains for food. What are we looking at there, Brendan?
Exactly. So the companies that operate in the region have a certain amount of inventory that they can absorb, some weeks of a shock. But once those start to run out, and their operations there, whether they're distribution hubs or some sort of assembly that they're doing there, and once they run out of the inventory to keep their production going, they're going to have real problems, and they're going to call on the government authorities for help, and the sort of band-aids that they've put up to try to bring in cargo on the road are going to become ineffective, and they're going to need a lot more help. So it basically the signal is that this is going to widen beyond the region, the economic impact, the price of things that we wouldn't normally think would be associated with an energy crisis in the Middle East will start to go up as well.
Yeah, if you have higher aluminium prices, you'll get that hit to manufacturing, and then less manufacturing goods to go through, right? A vicious cycle. But just focusing on oil, we've got a fantastic feature today talking about how the oil shortage impact is going to spread from Asia here to the West. What's the implication of that for broader trade?
Yeah, I mean, it's one of those things. Well, everything kind of runs on fossil fuels. Shipping, the ships that move oil run on bunker fuel, and so it's all kind of snowballing in a way that's really going to go beyond the energy question. I heard a story yesterday about a ship that needed to offload onions from abroad into the UAE. Now you can imagine, you think onions, how big of a deal is that? But you can imagine a shipload of onions that doesn't get to where it needs to go, with the impact that that would have on the food service industry where those need to go. It's that kind of thing that we're going to hear more and more of.
Okay. Brendan, thank you for the colour. Brendan Murray, our trade czar there, for a look at the impact on trade and shipping. Let's just take a look at what else we're watching throughout the week. Today we've got German CPI and the UK Chancellor Rachel Reeves joining a meeting between G7 finance, energy and energy ministers and central bankers as well later on. Tomorrow we have Euro area and French CPI as the French President Emmanuel Macron visits Japan and South Korea on Wednesday. On Wednesday, we have Artemis 2 launching, as well as US retail sales. And on Thursday, it's US jobless claims before on Friday, we get US unemployment data. But it is, of course, Good Friday, so we'll have partial market closures here in Europe and stateside. But joining us for more on what to expect in markets this week is Bloomberg's Morwenna Coniam from the Markets Today team. And Morwenna, I mentioned some of that US data coming through, but given that you've got the market closures and given so many developments in the Middle East war, how relevant will it be to traders' expectations of the Fed path ahead?
I think that's really an important point. It will be difficult to take a clear read. Also, data tends to be backward-looking, and I think right now markets are really looking forward. And in some ways, for the first time during this conflict, are really starting to price in what's a protracted conflict, really focusing on the implications for growth rather than inflation. And that's something we're seeing in the bond market today, with sovereign debt actually rising across regions, whereas we have seen it really taking a hit from those rising inflation expectations. Now people are starting to say, actually, these higher energy prices, which may be there for some time to come, are actually going to harm growth. And that actually means that central banks may take a more hawkish, have less inclination to take that really hawkish stance that had been feared. And actually, the focus could be on growth. So that data may feed into some of that. But I think actually something that's backward looking, particularly on a market closure day, is going to be difficult to really read too much into.
Yeah, so that's the US employment side. We get, before that, midweek, we get the Eurozone inflation picture. I wonder if that actually threatens to have more of an impact. It is data for March, at least, and it does relate to that pivot that we've seen in bond markets. Bond markets going from thinking about inflation to thinking about growth. They could get a reminder come the middle of the week about the inflation risks, I suppose.
Absolutely. I mean, we saw that to an extent, even with last week's CPI for the UK, which was, February, and actually we saw it in Europe as well, where it's like, oh, but even before March, things were actually not quite as good as policymakers would have hoped. I think certainly if it comes in hotter than expected, particularly given it is for March, it will be the first time we really do see some of the actual impact on inflation that the conflict is having, that the higher energy prices are having. Although, of course, we still haven't seen those higher energy prices properly filter through to households. Perhaps we have seen it at the fuel pumps, but we haven't seen it in terms of energy bills. That tends to be a bit more delayed, but we will start to soon, and that will be really watching.
Morwenna, thank you very much. That's Bloomberg's Morwenna Coniam, and that does it for the opening trade. The Pulse with Anna is coming up next as we look at the Stock 600 now in the green, up 0.1%, and US futures getting increasingly positive, up 0.4% on S&P E-minis. That does it for the opening trade. This is Bloomberg.
Ten years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams. Whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
Good morning. This is Horizon's Middle East and Africa, our top stories this morning. President Trump reportedly tells aides he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. The report by the Wall Street Journal sends U.S. futures and treasuries higher and oil sliding as investors take it as a sign of possible de-escalation. Meanwhile, Asian stocks are on track for their worst month since October 2008. Plus, despite talk of possible de-escalation, the attacks continue. Kuwait's state-run oil company says Iran has hit a fully laden tanker ship off Dubai, while the U.S. threatens Tehran's oil and water infrastructure. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Another flood of headlines to wade through this morning. But what I will say is markets are reacting to Wall Street Journal reporting suggesting that President Trump is considering an end to the military operations in Iran, even if it means the strait is still closed. So effectively there, he would be looking for a diplomatic solution to it. We're going to be discussing all of this, what it means, and the various mixed messages that have come out of the White House over the last 24 hours. So the point is, the markets are reacting to this Wall Street Journal story. And you can see here, S&P futures are actually in the green today, up 0.9%. Investors accounting for a possibility of a diplomatic breakthrough or indeed of an end to the war. So this is something that is being accounted for in positive risk assets, positive reaction risk assets this morning. And Brent, take a look there. We saw a little bit of a dip once that Wall Street Journal story came out. We're trading at around $107, but still a reminder of the effective control that Iran still has over the strait. And they did actually target a vessel that was just off the Dubai coast. This is a Kuwaiti vessel in the early hours of this morning. So just a reminder really of some of the risks underscoring tankers should they want to pass through the strait. So 107 is where we are for Brent. 10-year yield sitting at 4.32. We've rallied about 2.5 basis points today. So again, here taking note of what's been happening in energy markets, but then also some comments coming through from Powell yesterday as well, suggesting that inflation expectations remain anchored. So that came as a bit of a welcome commentary to the market there. So really not talking about long-term inflation expectations being moved by some of the commodity prices that we've seen or the uplift in commodity prices. And then USD trading flat today, not doing a whole lot. But of course, the theme over this war has been money going into the USD. It's up about 1.5% over the course of the last month. And then switching over, also just a flag, taking a look out, and this is something that we assessed on Friday, about 1 month into the war. What you're also seeing is emerging markets. Some of that rally, well, a lot of that rally has actually started to be unwound. And whether you're looking at bonds or whether you're looking at equities, some of the optimism around emerging market prospects has been taken out during the course of this war. And clearly there are concerns about the impact the energy shock could have on many of these economies, many of them oil importers, on their finances, some of the measures that Asian economies have had to take, including cutting fuel subsidies, trying to cut down on energy consumption, plus the impact that all of this could have on yields and some of the debt servicing costs for EM countries as well. So the emerging market rally has truly dissipated throughout the course of this war. But let's turn to other markets and talk about markets in Asia specifically. Avril Hong is in Singapore for us. Avril, run us through the price action today.
Yeah, we've been trading headline by headline here in Asia as well as the Wall Street Journal reporting came in. Prior to that, we actually had stocks in the region deep in negative territory. The region's benchmark at one point was just about erasing the gains for the year, and then we paired losses. That in mind, that being said, we are still looking at the bottom line being how energy prices are elevated. So that's still a trouble for Asia's economies, not to mention Asia's stocks. You can see how the Kospi is still about 3% down for the moment. And what's been interesting amid all this is how Chinese stocks, especially on the mainland, have emerged as the sort of relative haven. We are seeing them erasing the gains from earlier in the session, although prior to this, they were kind of buoyed by some of the data as well coming out from China, showing us PMIs were strong for the month of March as they return to expansion. But as I said, it's really this headline surfing that's going on and the risk sentiment pretty much dissipating this week again, no thanks to there no being an end to the war. Jumana?
Eva Hong in Singapore, thank you so much. Well, President Trump has reportedly told aides that he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. The report by the Wall Street Journal comes after Iran attacked a fully laden Kuwaiti oil tanker in the Anchorage area of Dubai's port, damaging the hull and starting a fire on board. Meanwhile, the White House continues to say talks with Iran are ongoing, as well as threatening further escalation of attacks, even as criticism of the war continues in the U.S.
Again, this is another historic opportunity for Iran to do the right thing, to rid themselves of their nuclear ambitions and to come to a deal with this president and the administration. Or again, they will see the grave consequences of the United States Armed Forces, which they are continuing to see every day throughout this operation.
He took us into this war in Iran without a clear plan, without an address to the nation explaining his goals, and without coming to Congress. And it's costing us billions of dollars a day. We've already lost 13 American service members, more than 300 wounded. I frankly have seen no evidence to support President Trump's assertion that there is a new, more moderate regime in place in Iran.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
For more, we're joined in Dubai by Stuart Livingstone-Wallace, our executive editor for MENA and Russia. So a flood of messaging coming through from the White House and from President Trump over the last 24 hours. He seems to, on one hand, imply that the Iranians are close to agreeing or coming to the table on a deal, but on the other, threatens once again to strike back at their power plants, desalination plants, even to take over Karg Island. The latest reporting from Wall Street Journal suggesting that he's thinking of winding up the war militarily, even if it means the strait is still effectively shut. What do we make of all of the messaging that's coming through, Stuart? And do we understand better what the US's objectives are?
No, I mean, the short answer to that is absolutely not. And the messaging, as you say, has been pretty garbled over the last day or two, and I would argue probably over the last month. It's very hard to see what exactly the end goal is here because, you know, if you recall when we started this war, the US president's very first video declaring the start of hostilities basically urged the Iranian people to rise up and seize control over the government, and that sort of disappeared over the last few weeks as a key objective. But in terms of sort of the end of military operations, you know, even if Hormuz remains blocked, you know, that is somewhat problematic because the ripple effects that are going through the global economy now, just about every level, largely center on Hormuz. And if you don't unblock Hormuz, you don't resolve any of the ripple effects that are causing all these ructions in the global economy. So while I think, you know, that it would be extremely welcome by all parties if hostilities stopped, Hormuz remains really the central issue. And it's very difficult to see how you can resolve that in the short term.
And Stuart, this isn't just about the closure or effective closure of the strait, but also about the risk being posed to vessels who want to transit through the strait. And again, this is underscored by the events overnight in which a Kuwaiti tanker has been targeted by Iran just off the coast of the Dubai port.
Yeah. And by my count, that's probably something like the 17th vessel that's been attacked since the war began. I mean, this one is, you know, deeply troubling because, yes, it is something like 30 nautical miles offshore, so it's in the anchorage area rather than in the port itself. You know, this is a very, very large ship, and I think it is a VLCC, which would imply it's probably got something like 2 million barrels of oil on board. You know, and that is, by its nature, extremely problematic if it's been hit. I mean, the slight upside here, I suppose, is that the crew is reported safe, and that's clearly a very comforting thing. And again, the UK MTO, which is part of the Royal Navy, saying there's been no reports of environmental damage yet. But again, we'll see over the course of today what that might look like. But it's a reminder
with the number of ships now waiting to get through Hormuz, this is deeply problematic. There are an awful lot, and clearly the Iranians are willing to go after them.
Stuart, thank you so much. Stuart Livingstone-Wallace, our executive editor for MENA and Russia. Well, let's pick up the markets conversation. Fed Chair Powell says longer-term inflation expectations appear to be in check, but that the central bank is carefully monitoring the impact from the war in Iran.
Energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate.
Joining us now is Anita Krishna Gupta, CIO at Wealthbricks Capital Partners. Well, Anita, you just heard me going over some of the headlines, the flood of messages that have come through from the White House over the last 24 hours. But the bottom line this morning is markets are trading like we may be getting close towards the end of this war. Is it perhaps premature for this optimism?
Good morning, Jumana. There are so many mixed signals coming from the market, and the most critical, of course, is what's happening with oil. So I don't see markets rallying unless we solve the supply of oil. We're all very well aware of the data around it, 20 million barrels through the Strait of Hormuz, 1.6 million from Iran continuing, of the balance 18.4, roughly 7 has been reinstated between Saudi Arabia, the UAE, and other strategic reserves. So there's about a shortfall of 11 million. So markets affected by lower economic growth, higher inflation, and we can come again back to what Chair Powell and the OECD are saying about inflation currently. So no, I'm not sanguine about markets as yet.
Yeah, I mean, the other question that I have, sort of in parallel to that, that if the U.S. winds down military operations, and by the way, here we're talking about the U.S., we don't know what Israel are thinking, but assuming the military side of things ends, but the upshot is that the strait is still effectively controlled by Iran. Doesn't that still imply that we've got months ahead of potential energy disruption ahead of us?
Absolutely, and it's a combination of energy fertilizers, urea, potash, helium. So it's affecting largely the Asian countries who are large importers of oil from the Strait of Hormuz, combination of India, China, South Korea, all the South Asian countries. So these get affected the most. LATAM less, the US less. We've already got the OECD coming out with new inflation numbers. We're seeing an impact on economic growth. We have seen the Asian markets affected more. The US S&P has fallen less. So now we're actually differentiating between oil importers and those countries which are self-sufficient in oil production. So we are definitely going to see global GDP growth affected by a Strait of Hormuz, reduction in oil and LNG. LNG, of course, affecting Europe the most at this point. So I would take this closure as a huge catalyst in terms of both market performance as well as the impact on global growth.
Yeah. Anita, something else that I've been watching actually from the sidelines, and this is not war related. Well, maybe actually, it is somehow linked to the war, but the fact that memory chips, and you and I have spoken about this so far this year, started off the year a lot of optimism and hype about the potential for memory chips, and there was a massive run up in pricing. They've started to come under selling pressure. And I note this morning in a chart flagged by my colleague that NVIDIA has actually entered into a bear market. So in the absence of tech stocks performing, can US indices actually do well?
So what we have been seeing with US tech is that you do have that occasional dip. I don't think there would be any lack of demand for chips, whether it's from NVIDIA, Micron, the largest foundry. So I actually am not at all bearish on my view of any of these companies. it's a bit of a sell-off in line with the market. They have gone up a lot. They are giving back more. People are booking profits where they see opportunity. I'm still convinced about the hardware space, especially memory chips continuing to perform with dips, of course. So yes, I still see US markets more resilient at this point of time.
Okay, if I just have to round things up for you then, how are you going to position over the next couple of weeks in the absence of clarity over what happens with the war? Are you staying defensive or are you waiting for an opportunity to buy the dip? What's the strategy?
Actually, we are going to be pretty defensive and we would be going a little bit more into cash. And that is, again, basically on the fact that we are seeing a disruption in oil supplies globally. So we are actually neutral equities. We're looking at actually taking a little bit, going a little bit underweight equities and adding that to cash. In terms of fixed income, we are not changing our strategy. We still prefer local currency emerging market bonds. We continue with our allocation of 5% to gold. That's defensive. So overall, we have got a very balanced positioning combination of fixed income, equity, alternatives, a little bit of hedge fund, a little bit of real estate. That positioning is not changing except for the very slight underweight on equities that we would be doing at this point.
Anita, thank you so much. Always good to chat to you, especially on big days like this. Anita Krishnagupta, CIO at WealthBricks Capital Partners. Well, coming up, oil and shipping traders on high alert as the Houthis in Yemen threaten another key trade route in the Middle East. We have the details next. This is Bloomberg.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. European officials say Iran is pushing the Yemen-based Houthis to prepare for a new campaign against Red Sea shipping. It comes as French and Japanese leaders are set to meet to discuss maritime security in the Strait of Hormuz. Joining us now is Wayland Soon, Bloomberg's oil and shipping reporter in Singapore. And of course, the other big news this morning is that Wall Street Journal article suggesting that the U.S. may end their military operations in Iran, even if it means the strait is still effectively shut. Now, I want to flag to viewers that you and the team have written a report that just went up, an article on the terminal saying Iran's Hormuz grip is tighter than ever after a month of war. So just walk us through the control that Iran has over the straits right now.
Sure, Jumana. So what we have seen is before the war, we can expect about 135, 140 vessels transiting the Strait of Hormuz in and out of the Persian Gulf. But ever since the war started, through a series of threats and real-life attacks, including one that we just saw this morning, Iran has really managed to scare the ship owners away. So they're not going into the Persian Gulf, and that's caused traffic to drop. And through this traffic control, if you can say, Iran is also now saying that it's allowing ships from friendly countries to pass through the Strait of Hormuz. So we have seen Indian ships, Pakistani, Chinese, even Malaysian, Thai. These countries have managed to get their ships out from within the Persian Gulf. So overall, we do see a huge drop in traffic through the Strait of Hormuz, and that is where Iran is tightening its grip. And of course, out of those, oil tankers are the biggest concern because it's a huge commodity that comes out from the Persian Gulf. And since the war started, Bloomberg analysis has found that 80% of those ships, the oil tankers that are leaving the strait, are linked to Iran or are on friendly terms with Iran. So it goes to show how tight the situation is for shipping and for energy flows.
Yeah, and indeed, many countries are looking to perhaps secure bilateral exceptions for their own ships, including the likes of Pakistan, as we covered yesterday on the show. But I also want to talk about the events overnight and the fact that a Kuwaiti vessel was targeted. It was laden with oil off the coast of Dubai. Just another signal that Iran isn't only controlling or looking to effectively control the strait, but it also has the ability to cause a significant amount of damage.
You're right, Jumana. So what we saw is a Kuwaiti flagged very large crude carrier, a fully laden one at that. So it's full of crude oil sitting off Dubai, getting hit. Initial indications seem to show that the damage is under control. Potentially looking for signs of an oil spill, but it comes after a lull in attacks, maybe about 10 days. So for a while, ship owners were looking to exiting the strait because things seem to be calmer. But now with this latest attacks, Iran is trying to show that it still has the capabilities to scare ship owners away from the strait. And this is a big issue because the anchorage of Dubai is a very crowded spot for ships wanting to exit Hormuz. And we don't know where this attack will lead us, but safe to say tensions are wrapping up again within the Gulf.
Yeah, and Waylon, just very quickly, how are shippers assessing the risk right now on the Red Sea and the potential for the Houthis to once again start disrupting shipping there and around Bab el-Mandeb?
So for a while now, the Red Sea has been pretty much close to a lot of ships with Western associations, especially those with US and Israeli links. This goes back to about 1 or 2 years ago. And so most of the ships that we see going through are linked to Asian companies. But now the situation is slightly different. We see Saudi Arabia trying to redirect crude oil flows to Yanbu, which is on the Red Sea. And you see more crude carriers, tankers, going to Yanbu, trying to get those barrels for their Asian customers. And if the Houthis do resume their attacks on the Red Sea, and they have not explicitly said so for now, it might scare away whatever that's remaining of the vessel traffic that goes through the Red Sea. But for now, we have to be mindful that there is no indication that the naval groups, the intelligence groups, think that the threat level in the Red Sea has increased significantly. But it's of course, things can change very quickly.
Okay. Interesting. Okay. Waylon Soon, thank you so much, Bloomberg's oil and shipping reporter in Singapore. Now for a look at some of the other stories we're following today. 3 United Nations peacekeeper troops have been killed in Lebanon over the past 24 hours as fierce fighting continues between Israel and Iran-backed Hezbollah militants. The UN Security Council is set to discuss the attacks on United Nations personnel, with France condemning the incidents and Israel's ambassador saying the responsibility lies with Hezbollah.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets. Powered by 450 billion daily data points and backed by research from hundreds of global experts. Delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Israel's parliament has approved the penalty of death by hanging for Palestinians convicted of lethal terrorism. Advocates say the measure will reduce the risk of another assault like that carried out by Hamas on October 7, 2023. The law was ratified by a vote of 62 to 48 with 1 abstention and is expected to face Supreme Court review. Human rights groups are condemning the move as discriminatory and retrograde. Spain has closed its airspace to U.S. planes who are involved in the Iran war. The move marks another step by Europe's loudest critic of U.S. and Israeli military actions in the month-long conflict. The country's defense minister says the same logic has been applied to the use of Spanish airspace as to the use of jointly operated military bases, which the U.S. couldn't use in the war. U.S. Secretary of State Marco Rubio says the U.S. may need to reassess its relationship with NATO after the Iran war is finished. He called the military alliance's alleged lack of support during the Middle East conflict, quote, very disappointing. Members of NATO have largely rebuffed Trump's request to help reopen the vital Strait of Hormuz. And a look at markets here, and things are trading slightly in the green on perhaps hopes that maybe the U.S. is looking to wind things down in Iran over the course of this week. But again, as we were flagging on the show, a lot of mixed messaging coming through from the White House here. Trump has claimed that they are close to getting a deal across the line. We haven't heard similar comments being echoed by the Iranians. But most definitely, we know that the diplomatic back channels are being worked. At the same time, this Wall Street Journal article suggesting that the U.S. could end their military operations in Iran, even if it meant that the strait is still effectively shut. So markets are reacting to that story. S&P futures up 0.8%. European markets less so, still up 0.3% in positive territory as we head into this European session. Now, coming up, President Trump reportedly tells aides he's willing to end the military campaign in Iran if the crucial Strait of Hormuz remains closed. As we were just talking about, we'll discuss the impact on energy markets with Sasha Foss, energy analyst at CSE Commodities, next. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. President Trump reportedly tells aides he's willing to end the U.S. military campaign against Iran, even if the Strait of Hormuz remains largely closed. The report by the Wall Street Journal sends U.S. futures and treasuries higher and oil sliding as investors take it as a sign of possible de-escalation. Meanwhile, Asian stocks are on track for their worst month since October 2008. Plus, despite talk of possible de-escalation, the attacks continue. Kuwait's state-run oil company says Iran has hit a fully laden tanker ship off Dubai, while the U.S. threatens Tehran's oil and water infrastructure. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Versace in Dubai. While walking in, markets are accounting for a potential de-escalation in coming days on back of a Wall Street Journal article saying that Trump is thinking winding down military operations, even if it means that the strait is still effectively shut. He would then leave that to a group effort, a coalition, so to speak, to somehow reopen the strait diplomatically in coming weeks and months. But that is what the report is saying. The reaction in markets has been quite astute this morning. You can see S&P futures up 0.8%, so pricing in some of that optimism here. Brent initially slipped on the headlines, but of course there's still a lot to contend with, and we're going to get into our energy segment now about some of the risks still underlying the energy markets in the coming months. So Brent sitting at $107 here. 10-year yields also slipping a little bit, sliding down about 2.5 basis points today, 4.32. Remember earlier in the week we're up at 4.40 and north of that. We had comments from the Fed Chair Jerome Powell overnight also saying that he thinks inflation expectations are still pretty anchored. So that also came as relief, I guess, to some fixed income investors. But the curve continues to flatten there. And then the USD not doing a whole lot today, slipping a little bit. But over the course of this war, the greenback has actually benefited. And then when you think about EM assets, also something to take a look at, especially given we're winding up the month of March. The war has been going on for a month, and what this shows you very clearly is a lot of the optimism that was baked into some of these emerging market assets has now started to be unwound. So pretty much all of that premium that was priced in has come out of those markets. When you're talking about bond stocks, as people get concerned, investors are really concerned about what this ongoing war could mean for higher energy prices, especially for some of those oil importing countries in emerging markets. All right, let's also check in on how markets in Asia are faring. Avril Hong is in Singapore for us. Avril, how have investors reacted in Asia to some of the headlines coming through about the war?
Yeah, as we've been discussing earlier, it's really trading from headline to headline. So stocks initially paired losses after the Wall Street Journal headlines, but now we're back towards those session lows. And indeed, if you look at Asia's gauge of stocks, we've pretty much erased the gains for the year. And that drag you're seeing is really coming from the AI, the chip-related names, the Samsungs, SK Hynixes, as the thesis in the early days of the war was that tech would be okay. Certainly that's been proven wrong, and we've been seeing these are the drags on the region's benchmark as investors worry not just about the AI scare trade or the chip memory-related stocks getting hit by selling after Google released its new tools. Investors have also been turning more defensive and away from tech stocks overall. And then add to that the cues that we got overnight out of the US as well, where those chip stocks also got hit. It's hard to see a situation where elevated energy prices and still elevated yields are going to be helpful for the tech sector in Asia. Jumana.
Avril, thank you so much. Avril Hong in Singapore. Oil whipsawing after the Wall Street Journal reported President Trump telling aides he's willing to end the military campaign in Iran, even if the crucial Strait of Hormuz remains largely closed. Joining us now is Stephen Jasinski, who leads Bloomberg's Asia energy coverage. So Brent, as we speak, now tracking around $107 a barrel, Stephen, but still in triple-digit territory. And just, walk us through what the effective, still ongoing closure of the strait might mean for energy markets, even if the war comes to a close.
Yeah, I mean, I think, you look at prices, and clearly the Wall Street Journal article, while we did see Brent kind of fall from some of its gains, there was a Kuwaiti oil tanker that was hit by an attack, and that kind of caused prices to rise in the morning. Wall Street Journal article helped pull things back. But again, like you said, we're still at well above where we were before the war began in Iran. We're at the highest level since 2020. And when you look at the oil that's coming through the strait, there's still 10 million barrels a day or 100 million barrels a week, potentially not being able to come into the market. And if this continues for 6 to 8 weeks, FGE's Feshraki says that we could see oil prices at $150, $200. So the longer that this continues, the higher it means for oil. But it's not just oil. It's refined products. It's natural gas. Liquefied natural gas has no alternative routes, unlike Saudi Aramco, which can send some of their supply into the Red Sea. There's nothing for that for Qatar's largest LNG plant, which produces about 18% of global supply. That's shut. The UAE can't send their LNG through the waterway as well. That's putting upward pressure on gas prices, and every day that remains shut, it's another risk to global LNG because there just isn't enough spare supply elsewhere. So while maybe there is an off-ramp discussion, maybe there is discussion about Trump calling victory and ending this war, if the Strait of Hormuz isn't part of it, and if there isn't a real clear indication as how that will open and flows will resume, then I think both the oil and gas market will remain elevated, according at least to the analysts that we've spoken to and been on TV here.
And Stephen, what further policy options does the U.S. actually have to help support this market? We've spoken about the record release, the IEA stockpile record release that started to filter through bit by bit. We've talked about them removing or lifting the sanctions on both Russian and Iranian oil. Are there any policy options left for the U.S.?
Yeah, I mean, those are the big ones, and you've seen the Trump administration really pull the handle on the Iran, whatever's on the water for Iran, whatever's on the water for Russia, maybe easing different restrictions on as well Russian producers like Lukoil. You also have the options of trying to boost output out of the United States, but that's limited as well to certain degrees. You have other, obviously the joint release of strategic reserves is a big one, but that's more of a bandage. That's not adding more barrels into the market. The U.S. could use potentially some of their Navy to help with escorting vessels through the Strait of Hormuz. We haven't really seen that. Instead, it's been more Iran using their sort of system to escort a limited number of vessels that they've approved through the strait. You could as well see the U.S. providing support for insurance for vessels that want to take that route, want to risk it. But again, the details of exactly how that would play out and what guarantees the U.S. would provide haven't really been set in stone either. And those are the main ones. But I think obviously the market is clearly looking at not just these sort of temporary solutions. They're looking at a de-escalation. They're looking at some sort of way for the U.S. to solve this situation on the ground.
Stephen, thank you for setting it up for us. Stephen Sachinsky, Bloomberg's Asia Energy team leader. Let's continue the conversation now with Sasha Foss, energy analyst at CSC Commodities Marex. Well, again, a lot going on in the energy space, but let me just ask you whether you're also in the camp that we will, in the coming weeks, so long as the strait is effectively shut or controlled, continue to see this upward push on oil prices.
Thank you, Jemima. Yes, certainly. As long as this conflict continues and the strait remains shut or controlled by Iran, then the structural oil price really is embedded higher. This has been the scenario that the industry's been fearing for the last 50 years. And what this conflict has shown is that it really is possible for Iran to conduct this asymmetric warfare and control the straits. So certainly, it's not only the straits being shut, but it's all the energy infrastructure being hit. Oil reservoirs, they're not like light switches. You can't just turn them off and on quickly. There's damage which will be very long lasting. The LNG, the Ras Laffan that your colleague Stephen was just talking about, they project it will take 3 to 5 years to have production back to where it was. So certainly this is a war of duration, and it's already been a month now, and the longer it goes on, the worse it gets, unfortunately.
Yeah, do you have a view on where oil prices could top out? I mean, I've seen 150, I've seen 200. What are some of the clients that you're speaking to saying?
Yes, I mean, it's difficult to predict. We'll have demand destruction at a certain point. I mean, oil demand is inelastic by nature, so you do have to get to these quite high prices. The highest price was in 2008, which was around $147, but in terms of money today, that's 220. I think certainly, I don't think that actually the Brent crude is the number to look at. I think where we'll see the demand destruction is through refined products or the crude grades in the Middle East, where you've already seen Oman and Dubai crudes at around 180, because that's really localized to where the crisis is. And we've seen jet fuel above $200 per barrel in Singapore. So I think those are kind of the benchmarks to look at. But certainly oil has a lot of room to grow. And unfortunately, as bad as things are, they can always get worse. And I think we've seen all those policy decisions that are kind of short-term fixes. The IEA release, as you said, the 400 million barrels, the Jones Act waiver, the relaxation on sanctions on not only Russian oil, but Iranian oil. And I think those are kind of one-shot bullets. So once those finish, then oil will jump up higher.
And the other thing that people have been talking about is the wedge that's emerging between WTI and Brent, given where the bulk of the Brent is produced, emanating from the Middle East region. And I wonder whether that could actually become a more structural feature of the market, as even in months, years ahead, investors have to account for perhaps a little bit more geopolitical premium to Brent now, especially from some of those Middle East producers.
Certainly, that's very true, Jemima. I think the WTI Brent spread has been at multi-year highs, and I think also some of that, Brent's always been more of an international geopolitical marker, but it's also, I think, as the war goes on, the U.S. administration might reach for desperate measures, which include a crude export ban. So we saw the gap widening whenever those rumors kind of float, because the U.S. didn't become an oil exporter, I think, until 2015 when Obama lifted the crude oil export ban, and we've heard rumors that the U.S. administration was considering that, which would trap oil in the American continent and therefore make it relatively a lot cheaper. However, it is important to underline that this really would be catastrophic for crude oil markets, because the US tends to export a lot of its light, sweeter oil and import kind of heavier crude from Canada or even Venezuela. And if we were to kind of undermine this free market, then it would be catastrophic to the rest of the world.
And finally, just to round things up, because this is also significant, Houthis entered into the war on Saturday and they launched projectiles towards Israel. What is the level of concern in the energy industry about them looking to once again disrupt shipping on the Red Sea?
Yes, it's a good point. I think the concern's very high. We hadn't really seen the Houthis until now. Obviously, a few years ago, they had kind of made the Red Sea a choke point, and they can fire missiles from the Bab el-Mandeb Strait, which is the other choke point of the region, which would really trap supply even further. Obviously, we've seen the East-West Saudi Arabia pipeline, which has a capacity of almost 7 million barrels per day, which has really been kind of the world's most critical infrastructure right now, as it allows a lot of the oil to bypass the Strait of Hormuz. Now, obviously, from the Red Sea, you can take the channel up the Suez Canal, but it's Asia that's really kind of screaming right now for product that's been most impacted by this crisis. And so the closure of the Bab el-Mandeb Strait would just make supply chains even longer and take more supply off the market. And that really is kind of a deep concern for the market right now.
Yeah. Sasha, thank you so much for joining us. Sasha Foss, energy analyst at CSC Commodities Murex. Thank you. Well, coming up, fuel shortages begin to hit parts of Africa as the Iran war dries up energy costs. We'll bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Brisacci in Dubai. The fallout from the Iran war is now hitting African economies, with fuel shortages emerging across parts of the continent. The shock is set to ripple across Africa, raising transport and food costs in some of the world's poorest economies. Our chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. Jen, how widespread are these fuel shortages across Africa, and which would you say are the countries that are most exposed?
Well, Jumana, if you look at how widespread they are, it's quite widespread across the continent. But it really, you have to dig down into the severity depending on the country and also the response depending on how these governments are responding. That's sort of how we've been taking a look at it. So if we look at it from just one point of view, the most exposed countries are really those that are heavily dependent on the Middle East and they're non-oil producers and largely dependent on some of these imports that have been coming from the Middle East. And we've been hearing from a number of these governments that have been trying to at least caution the public without causing any sort of panic about potentially being a bit more conservative with their own fuel use. There's also those smaller, lower income economies that don't have the sort of strategic petroleum reserves or even the FX reserves that some of the bigger economies have that are also a bit more exposed to what could potentially be even more of a shock. Now, we have been reporting on this for quite some time, and Jumana, as you know, those that are potentially less exposed are the ones that have a bit more of supply or of stock. Now, I'm talking about the likes of South Africa, which has communicated that. There's also Kenya and Uganda, which have said they have a few weeks of supply. And perhaps in the most stable position, of course, is Nigeria. Of course, Nigeria is an oil-producing country, has the refinery, so does have some capability to refine its own crude production. But still, most of that has been maintained for local domestic use. And so it's really varying degrees. But what we're looking out for is just how long some of these reserves for some of these economies are going to be able to hold them over until it may potentially get a bit more concerning.
Yeah, and Jen, I've been reading a lot of stories about how some Middle Eastern nations, how countries in Asia are looking to advise consumers on how they can limit their energy consumption, including a reduction in using air conditioning units, for example. What are some of the measures that African governments are undertaking here?
Right, Jumana, it's interesting because it's been the response here has been a few weeks because governments really regulate the prices on a month-by-month basis. So what we're waiting for, especially here in South Africa, is really what the percentage of the increase is going to look like. And so where in Asia they have been taking some of these measures, as you were just mentioning, here in Africa it's still sort of hitting reality a little bit slower than it has elsewhere in the world. So you just mentioned some of those. What we've been hearing, we saw Ethiopia has been telling citizens to conserve their fuel. In some cases, they're even encouraging work from home, so less people are having to spend money on paying for fuel. Tanzania is trying to actually strengthen its borders to stop smuggling of fuel to other fuel-trapped neighbors. And then just finally, we have Namibia, which says they're actually going to slash fuel levies. So again, just varying degrees of how these governments are responding. But we'll really see what the prices look like when it comes to the pump and how that affects citizens, not just at the pump, I should say, just across the board on the supply chain.
Jennifer Zabazadeh, our Chief Africa Correspondent in Johannesburg, thank you so much. Well, coming up, the Iran war hits metals markets, sending aluminium towards its biggest monthly gain in nearly 2 years. We'll discuss that next. This is Bloomberg. Aluminium, or aluminum, headed for the biggest monthly gain in nearly 2 years as the war in the Middle East disrupted supplies and damaged local production facilities, tightening the global market. For more, we're now joined by Michelle Long, head of Asia Metals and Mining at Bloomberg Intelligence. Well, yesterday we were talking about the fact that 2 major aluminum smelters in the region had been targeted by Iran with some damage inflicted. What has been the reaction around the world to what is happening in the region, and particularly as it pertains to aluminium prices?
Right. So actually we can see from 3 sides about the impact of the war to the global aluminum industry. I think, first of all, the oil prices or the gas prices has actually boosted up the global energy prices. So each would have a heavier impact on the smelters because they're very energy intensive, especially smelters that rely on the imported gas, such as those in the EU. However, on the other side of the country, like in China, Indonesia, India, Russia, they mostly rely on the domestic coal supply, so their energy cost would be more immune as compared to those. So they would also benefit from a higher aluminum price as well. Well, secondly, I think besides energy price, the logistics or the supply would be also affected globally. Not to mention that the Middle East itself accounts for around 9% of the global aluminum supply, but also they would have been impacted by the disruption of alumina imports because of the logistics. And all over the world, the logistics or the shipment cost will be higher, along with the higher insurance premium as well. So countries that has to rely heavily on the imports, such as EU or US, they will suffer. The consumers have to pay higher prices for the imports. And now they have to divert their imports from the Middle East to other countries, such as Canada as well. So this is on the logistics. Of course, demand is also being impacted by the war. We expect the global economy might slow down. Yeah. And effectively, in our scenario, we expect the demand to slow down and the supply to slow down a bit as well. So after all, we think Canada could be one of the greatest beneficiary from that, just because, as I said, this country's smelters, they more rely on hydropower, so less suffering from the high gas price. Yeah. And secondly, more countries would need to seek alternative to replace their supply from Middle East. Yeah, and Michelle, also they would benefit from the higher price as well.
Great. Thank you so much. Michelle Long, head of Asia Metals and Mining at Bloomberg Intelligence. Well, that wraps up our show, Horizons Middle East and Africa. Stay with us for Daybreak Europe. This is Bloomberg.
Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Snarky. We're a little snarky here today. It's just Liz and myself on the market call. There's Liz Thomas. She's a crowd favorite, a fan favorite, and we're really excited to have you and me here.
Thanks,
Guy
guys.
Adami. I'm just gonna dox Guy Adami, and you're gonna see why I'm wearing this color shirt. He is down at UNC Chapel Hill, and their colors are. They call it Carolina Blue, which is kind of cool. I wonder if it was named Carolina Blue because they have the colors or they're just coincidence.
My dad would know the answer to that question. I'm going to text him and ask him.
Please do. He is, guys, talking to a bunch of different groups about finance, about markets, that sort of thing. So we're Miss Guy today. Liz, we got so many questions to answer, and most of them are mine. This is one of those markets that is just every other day, it seems like there's just certain relationships that are ping-ponging against each other, right? Yep. Oil up, stocks down, right? Software up, semis down. You know, and it's just been going like this. And it's really hard, I think, for a lot of folks to kind of figure out what these headlines on a daily basis about this war in Iran mean for our markets, but more importantly, I guess, for the economy. So your note out today, we're going to talk a little bit about consumer spending and the impact of higher oil on them and really what goes into consumer spending. And that's something that I think a lot of folks, like, you know, they get really used to, you know, these sorts of environments where we have uncertainty and they latch on to a couple things that are most important. But this is one of the ones that it's not just the impact on consumers, price at the pump, you know, higher food prices, that sort of thing, but it's also about supply chains. And this is really comes down to companies, you know. And so what are you most focused, like our listener, our viewer right now, if they're trying to make sense of all this, as I am, as you are, where do you think you start thinking about the economy and then how it might trickle into some of the risk assets that we talk about every day?
So I'll start with something that I heard Dan Greenhouse say either yesterday or the day before. Basically, it's never about good or bad. It's about better or worse. Mm-hmm. So the market reacts to whether or not we think the situation is better today than it was yesterday, worse today than it was yesterday. I agree with that. Mm-hmm. However, we're getting sort of whipsawed around by all the jawboning, not just from the US, but from Iran, from everybody out there that's trying to say, yes, we're talking, no, we're not talking, we're interested, we're not interested. The demands that have been made don't match, right? The ones that they've made, we don't want to meet. The ones that we've made, they don't want to meet. It's just, we have not agreed on anything yet. Mm-hmm. And the market continues to be volatile about it. I want to say that the first thing that you want to focus on war-wise is the supply shock, because that is really what has disrupted markets. Of course, violence is never a welcome thing, but what has disrupted markets and what's baked in now to inflation expectations, the fact that there's a Fed hike being discussed instead of a cut, it's all about the supply shock. So what alleviates the supply shock? The straight reopening. It is not reopened. Apparently, you can send ships through it if you are completely uninvolved in this conflict, or you can pay Iran.
Paying like a couple $1 million per ship, which is insane.
Right. But maybe some companies will do it. Maybe some suppliers will do it.
That'll end though because of the sanctions, right? So if you think about it, like, you know, like most countries in the world, based on our sanctions of Iran for the last, 15 years, have not been able to buy their oil.
Correct. Yeah. So regardless, if the strait is not reopened, the conflict is not resolved. And the supply shock is not resolved. So it will continue to push through into markets. It'll continue to push down into consumer prices. So that's what you focus on from a war perspective. From a risk assets perspective, I still do not believe that this market has priced in the possibility that this continues for a long period of time, or that it really becomes entrenched in inflation expectations and that it starts to take a bite out of company earnings. Earnings expectations have actually gone up. Yeah. And you told me something that we'll cover earlier before the show, that basically the target that people have on the S&P is really high for the end of the year. So we'll get
a little tease, John Butters, earnings insight.
So it's possible that the earnings stuff is overstated for now. Mm-hmm. The market has not priced in the worst case scenario. I still believe that it's very possible we see a worse flush before this actually gets better in a durable way. Mm-hmm. I think the biggest risk, well, let me take this back. Two big risks. The first big risk is that it doesn't get resolved. The conflict just drags on. I don't think that's in anybody's best interest. Something will resolve it or at least quiet it down. The second biggest risk is that it simply quiets down. It doesn't get resolved, right? Neither side actually achieves their objectives. So this remains a problem, and we've just sort of pushed it out into the future, and it remains a threat. And that'll be a problem for oil prices no matter what.
And I think what you're saying is also that's probably the most likely outcome, right? So, you know,
Right
a lot of
now
the
it feels that
reporting,
way.
you know,
Right.
there was an article in the Wall Street Journal this morning basically saying Trump's getting bored of the war. You know what I mean? And no, I mean, like literally that's what the article says, but you know, you've heard people say this is like you can cancel tariffs, you can taco on that sort of stuff because even before they made any impact. But what you're talking about is if you basically kick the can down the road, both sides are going to claim victory, right? But getting some of these supply chains back up and running and not having some sort of, you know, kind of hangover effect, you know, is probably a different sort of thing. Now, if you can, you know, a lot of people were saying this about the tariffs last year, it's a one-time sort of thing. I never understood that. It's a one-time hit. Well, isn't this the whole thing about inflation? It's not that the CPI is at 2.4%. It's that it was, you know, on an annualized basis, it's been going up, you know, 2%, 4%, you know, that sort of thing. But prices on a, you know, 5-year basis are up dramatically. What food prices are up 30% or something like that since 2020?
Yeah. I mean, tariffs, I guess, are a little bit more of a, I hate to use the word transitory, but I suppose they could be more of a transitory effect.
That's what Fed Chair Powell was saying. That's what a lot of, you know, from a political standpoint, that's what a lot of the administration wanted to claim too.
However, it's not like they all hit in, you know, March of this year and then it's over. They take a long time to actually work their way through the system, which Powell has said as well. So it's not going to feel transitory, but really the impact of just the adjustments that would occur and the fact that tariffs are much lower now than what we originally thought, it probably isn't as bad as what we originally thought. The issue with this particular situation, to your point, is that we can't just take it back now because there are all these other countries that have been brought into it. I said this, I talked about this a lot on Closing Bell the other day, that damage has been done already. Facilities are ruined. Supply will continue to be constrained until a lot of that can be rebuilt. And there have even been claims that it's going to take years to be rebuilt, and some natural gas in particular. But damage has been done. You can't just push the off button and say, okay, everything go back to normal business as usual as it was beforehand. Now, the market may do that initially if we suddenly decide, okay, we're done with this conflict. There's a ceasefire.
We're done.
The market may seem like it's going back to normal. But I think supply remains constrained. I think oil prices remain a little bit higher than where they were before. And the threat also remains. So I don't think that there's an easy fix to this. And not to mention, and look, I am no war expert. I'm coming at this from a very ignorant position. So please do not quote me on what the administration is going to do. But we're sending troops over there. Every couple days we hear about more troops. They're not going over there to like hang out. So we're ready if we decide to do something more on the ground. And there is a chance that it escalates before it de-escalates.
Yeah. And again, you know, there's other headlines that could come out that could be that shock to the market. Like if there was any terrorist activity, you know, anywhere, that would be, you know, something that our response would be very aggressive. And there's another scenario is like, let's just say the way the Iranians think that they can get leverage by just bombing UAE and Dubai, and I guess Dubai and UAE are about the same thing, but you get my point. They're sending missiles over to Saudi. You know, if anything were to happen and bring the Europeans in, then it just gets messier, you know, and Trump's been threatening. I mean, I wonder if there's a threat of higher tariffs that are going to come for those countries that don't participate and that sort of thing. So again, let's pull up the S&P 500 because I really think this chart, to your point, you think there's probably some sort of capitulation or some sort of flush, right? And that would make the administration, if we see yields going higher, we see the S&P going lower, you know, that sort of thing, and oil sticking around, let's call it 90 to 105 or something in that sort of range. You know, you look at this, it's below that 200-day moving average. Give me a 2-year, if you don't mind, Amanda, because I think what's going on is like one step forward, two back. If you just think of the price performance in the S&P over the last, call it, you know, month or so. And here we are, we're down, you know, we're only down 6.5% from the all-time highs. And it doesn't feel that bad. Do you think it feels that bad so far? And like what's the stat? Every year on average, we have a 10% drawdown from a
I think
high.
it's actually 13.
Yeah. So I mean, when you think about that, we haven't had more than a 5%. I mean, maybe you have to go back to November to December. But the last time the S&P, make it a 5-year now, if you don't mind. The last time the S&P went below its 200-day moving average, we know what happened. I mean, so could we get back towards those prior highs before? What was that, about 6,000 ish or something like that, going back to February of 2025? So technically it feels weak, and I'm just curious your thoughts on where investors might think about, okay, there's some unusual bargains in the stock market, because there certainly is on a sector basis, and there certainly is on on a single stock basis within those sectors.
Yeah, there's a reason people say nothing good happens under the 200-day moving average. So the fact that it breached that level last Friday, and that then Trump came out and was like, oh, we're willing to talk, and then we'll push back this strike on Iran, not a coincidence at all. So under the 200-day moving average, things get a little dicier. But to your point, only down 7-ish% at worst from all-time highs is not a flush.
Yeah.
And it's not even a regular correction. So there is plenty of room for us to still even have a garden variety correction by magnitude and come back from it. There's also room for us to have something sniffing at a bear market and come back from it. We've seen that happen multiple times in this cycle already. So I think markets are underappreciating the possibility that this could get worse. It's also possible that we're all just continuing to hold on to hope that it doesn't. We all know that the left tail risk is bigger than the right tail risk right now, meaning the risk of downside is bigger than the possibility of more upside. And we also know that if taco does happen, there's probably going to be a V-shaped bounce in the market initially. But I don't think that we're going to get to a place where we just forget about it like we did about Liberation Day, because this is different. This is a different feeling. This is more global. This is violence and war, which is different than just saying I changed my mind about something, right? So I think we're in a different scenario here. This is also something that has the potential, if it doesn't get solved, to cause a global recession.
Yeah.
Now, the US is much more insulated from a lot of what's happening in energy prices, but if it takes Europe and Asia down, the globe is screwed.
Yeah.
Right? You can't survive.
45%
that.
of S&P earnings come from, outside the US, that sort of thing.
Right. So this is really important. And I think we're at an important juncture of it too, where in the first 2 weeks of this conflict, I would have said, okay, if it de-escalates and goes away, we go back to the trends that prevailed before this, and we do sort of forget about it. It was like this cute little fight that we had. Now it's been almost a month, and companies are going to have to start changing their approach. Cost structures are going to change. Consumers will start to adjust their approach because it's taken a bite.
Well, and you're also going to see basically one of the first things that companies do, right, when they're cutting costs, they'll fire people. And, this is almost a mulligan for a lot of companies who, let's say, they're getting massive productivity gains from AI, right? And they don't really want to be out there firing people because of that right now. But if you kind of throw in, some of the stuff that we're just been talking about for the last 5 minutes, it's giving you as a CEO or something, it's giving you a little cover, to do this sort of thing.
Yeah. You can explain it.
Yeah. But let's talk some sector stuff. I just want to